Bismillahirrahmanirrahim. Alhamdulillah rabbil alamin wa bihi nasta'in wassalatu wassalamu ala Rasulillah wa ala alihi sahbihi ajma'in. Assalamualaikum everyone. Okay, it's after lunch break, so I hope you are still awake because we're going to go through on Islamic project financing. There's quite a number of audience here, but I think some of you are still maybe doing the prayers, right? But I will start because of time. I think we're supposed to start by 2. And also to give due respect to those who are here early. So we should start on time, basically, right? So we're already late by 5 minutes, so it's okay. So basically, if you look at the topic, is on Islamic project financing. How many of you have been involved in any kind of project financing before? Not necessarily Islamic, but just project financing. Can I have a show of hands? None of you? You are? You have been involved? Huh? Yeah, can you explain a bit on that project that you have been involved in? Uh-huh. Syndication loans for basically oil and gas, is it? NTN, okay. And you are from Aeon Bank. Okay, good. Okay, I'm not sure, but I shouldn't be too close with the other mic, I guess. Okay, so good. So there's somebody now with some experience on project financing. So basically, my main talking points would be first on an overview and also definition of project finance, because I'm not sure, maybe some of you are not familiar with project finance, so it would be good to know what project finance is, what are its main characteristics. Okay, so after understanding project finance, we will look at the Islamic aspect of project financing. So how do we actually do project financing in a Sharia compliant manner. And then we look at the technical parts, basically the instruments, the contracts that are used for the purpose of Islamic project financing. We look also at some case studies with some transaction structure, so you can see how the mechanism when we do project finance under Islamic principles. I'll give you just some list of examples of Islamic project financing in the past and also the way forward. Okay, the format of the course, basically, I will do my presentation, but you can always interrupt me if you feel like you need clarification along the way. Just raise your hand and we can just discuss immediately. You don't have to wait until the end of the session. Okay, yeah. So basically, when we look at project finance, it's about financing projects. So its focus is actually projects in the sense that when the person or the financier finance the project, they're looking at repayment sources actually coming from cash flow of that project. So that's why the project generally should be good and having cash flow so that the financiers are comfortable about giving the financing, because the repayment and also profit and whatever that the financier is expecting to have generally would come from the cash flow of the project itself. Okay, so that's actually the main characteristic basically. Financier look to cash flow of the project for repayment of the financing amount. This is in general lah, project financing in general, not necessarily Islamic. It's the same characteristic. And it's actually a primary means or primary mechanism or method or way to finance a broad range of economic units. So when we talk about economic units, this basically means the project lah. Like for example, infrastructure projects, power generation, highway construction, oil and gas, mining, manufacturing, you can name it, all these economic units can be financed through project financing. So this is the basic definition. The financing of an economic unit, basically the project, which the lenders look initially to the cash flow. Of course, after the cash flow has steadied up, then you look also at other assets comprising the economic unit. Because once you did or basically when you finance the project, initially there will be cash flow, and then later the project will actually it will build assets. Okay, so those assets will also be a source of repayment. It becomes like collateral for the financing or loan given. Okay, so that's the basic overview. So when we look at key highlights in a project financing, you can look at this statement here: raising of finance on a limited recourse basis. So normally project finance, there's limited recourse, meaning that your recourse is actually to the project. So you don't have recourse to the other general balance sheet of the company involved. Okay, so you are actually having limited recourse more on the project itself and the assets under the project. And normally the purpose is actually to develop large capital intensive infrastructure projects. So normally it's a large project, capital intensive, you need a lot of money. And then, so normally infrastructure lah, okay? Because normally infrastructure, you will have a kind of award from a government or sovereign, that you have the government or sovereign promising certain amount of money to be paid for the project completion. So there's cash flow already identified there. And then the borrower normally is a special purpose vehicle. So when you have special purpose vehicle, are you familiar with special purpose vehicle? Okay, so this is to actually create like a ring fence entity which is separate from the company itself. So you have like a finite time for this project company as an SPV to do the project. So you have recourse to this project company basically. So the repayment of the financing will be dependent on the internally generated cash flow of the project. So you look at internally generated cash flow of the project itself. So that will be the source of payment for the financing. Okay, clear? The cash flow, understood. So special purpose vehicle just now to have a separate entity specifically set up for the purpose of that project. Okay. So in summary, project financing is a scheme of financing whereby customer will be able to pay the financing amount progressively. So normally it follows the progress of the project in tandem with the project. Normally, you can have like smaller sum at the beginning because project not yet fully operational. So you have a small payment, and then it will actually be increased upon operationalization of the end project. So you have to have more cash flow. So you can actually structure the repayment amount to tally with the amount of cash flow generated under the project. Okay. Sometimes we have project financing even for the first 2 years, no payment yet, zero payment during certain period, and maybe on the 3rd year or maybe on the 18th month only you have some kind of payment, because then is only when the project started to generate cash flow. Okay, so that's one thing. So cash flow is the sort of income of the repayment, and also normally is secured by project related asset. So you're talking about power plant, maybe some of the plants can be used as the collateral. If you're talking about project financing to build an airport or aircraft vessels, so the vessels and the aircraft can be the collateral later, okay, once they are completed. Okay, it's meant for manufacturing, construction, or other capital intensive infrastructure projects. And the project financing may involve one layer, like straightforward one layer financing like bridging. You can also have multi-layer or multi-phases kind of financing. You can also have debt security features like sukuk as part of the financing tranche. So you can break up the project into various tranche, maybe first tranche bridging, and then you have the main tranche, and then you may want to have some kind of other arrangements at the back. Okay, so it can be multi-tranching kind of transaction. Okay. Many project financing involve infrastructure financing, and when we talk about infrastructure financing, because generally it's the government who's going to or responsible for providing the infrastructure, then you can also see the government as a party to the project. Like in Malaysia, we have a lot of highway projects, right? Plus, Lekas, Duke, Suka recently. So many highway projects, and the government will be there as a party because they are going to actually provide the concession, the award for the right to construct and generate income. Okay, so the concession agreement between the government and the project company will also be like part and parcel of the overall project financing. And basically that actually provides strength to the project lah, because you have to some extent there's some kind of, even not government guarantee, but at least there's some government entities going to pay if the project managed to be completed according to the specifications of the government. So you can have like highways, you can have schools, hospitals developed under this kind of financing. It is possible to use structures like BOT, Bill Operate Transfer, or other similar structure because that would meet the government kind of projects where you have concession period and you have transfer of the asset later to the government. And because it's capital intensive, the amount of capital needed is huge. Then most of the time, project financing would also require syndication, where you have more than one financier coming together as a consortium to finance the project. Because financial institutions, they have their limit basically for prudential purpose. They cannot put all their money in just one project. So they will partake in some portion of the project, and then there will be other banks and finance coming in. So there will be a syndication. And normally there will be a lead arranger or lead party who's going to lead that consortium or that syndication. Okay. Anyone of you from the banks? You are from Aeon, two of you. The rest? You are also from the bank. You are from CIMB Islamic. Okay, yeah. So model project financing is normally used to finance large infrastructure project where there are a consortium of participants, and then there's main characteristics of project finance. One is capital intensive, highly leveraged. Okay, so most of the cost of the project actually is coming from financing, like not from the company itself. Long-term tenure, because you can see the project like highways, like this one, Trans-Aslankan pipeline, the MB Manjung plant. Okay, so it's a long-term tenure. And then the project company would be like SPV, independent entity with finite life. Okay, the life of that SPV would be in tandem with the tenure of the project. Okay. Then generally it can be like no recourse. So your main recourse is just to the cash flow of the project, or limited recourse, like maybe you have some kind of government guarantee or something like that. So you may have limited recourse, or you don't have any no recourse basically. Okay. Then just one example, Lekas. Anyone of you from Negeri Sembilan? Anyone have been using Lekas? I believe all of you must have been on Lekas Highway. Okay. One of the transaction which was financed later by Sukuk, and it was known because of some kind of problem, default, and all those things lah. But finally, it is completed lah. Okay. So in terms of history, it was approved by the government back in 1997, a long time ago. I think all of you are already born by 1997. Hopefully. Okay, so although it was actually approved by the government in 1997, but the construction only started in 2002. Okay, and then there was financial problem faced by the original concessionaire, basically Kajang Seremban Highway Kasih, and then this caused the construction works to be delayed. I think one of the main issue was actually the projection of the traffic. Traffic that is expected to use the highway. There was some mismatch in the original projection and the actual traffic. So that caused some problem later, even after completion, in terms of cash flow and the ability of the issuer to meet their obligations under the Sukuk transaction. Okay, so they had initially the problem, 2002. It was further revitalized in November 2006. takeover by new concessionaire, Lebuh Raya Kajang Seremban Highway, Lekas, where they took 50% stake held by IJM Corporation. The rest actually held by original concessionaire, basically Kasih lah. Okay. And it was finally fully completed in March 2010. Okay. So I think the second phase after the takeover where they did the sukuk for Lekas Highway, Lekas sukuk, but still because of the projection of the cash flow had not been accurate, there was some hiccups in terms of the payment to the sukuk holders. But I think finally all was fine. Sukuk holders get their payments. Okay. So this shows an example of a project financing. If you compare project financing with other forms of financing, like the normal corporate lending, the corporate lending like just a company borrowing from the bank or a company get an Islamic financing from an Islamic bank. So in terms of the commonalities, there's a financing given, a conventional loan under Islamic, we call it financing. And in terms of the payment, normally dependent on the cash flow in order to pay the debt. And normally they use loan structures or debt structures under Islamic. The key difference actually is for the unsecured corporate loan, the lender would have recourse to all the assets of the company who is borrowing. Basically, whether that asset comes from the specific asset under the project or not, or any specific asset, I mean, it's not limited to that. If it is a secured loan, of course, you can recover from that asset which was made collateral under the lending. But for project finance, the borrower would be the SPV, project company. So the recourse is only to the assets of the SPV, not to the actual company who may be the actual party behind the project. Okay, so because of that, under project finance, the principal security actually the future cash flow of the project itself. So sometimes it's known as cash flow lending. So that's the difference between project finance and normal corporate lending. If you compare project finance with securitization or asset-backed securities, the main commonality is you have under the ABS SPV also in the structure, similar like project finance. But then for asset-backed securitization, it's an off-balance sheet financing for the originator, where the SPV issue bonds to fund the project. Okay. For project finance, it's not really ABS. You can have SPV. You don't have to issue a bond or sukuk for that matter. But if you were to issue bond or sukuk, it is still not asset-backed basically. It's not like the ABS where you have a true or real transfer of the asset to the SPV. Here, it's more of basically a single SPV, and they actually invest the money given under the securitization transaction to finance the project, and you can have the asset portfolio which are revenue generating to pay to the investors. Okay. For venture capital, in terms of the commonality, you have multiple investors coming in to finance that project, just like venture capital. But in terms of venture capital, they are very much earlier on in the business of that entity. So because of that, it's quite speculative in terms of the potential returns to be generated by the company. Whereas project finance is more of more predictable financial forecast and cash flow because they already have like long-term and highly predictable cash flow that they can rely on. Okay. Okay, in terms of the stakeholders or transactional parties in a project finance, typically you would have first the sponsor. So if you go through project finance documents, you can see you as the sponsor. Who are the sponsor? The sponsor are basically the equity investor and owner of that project company. Okay. And then the project company or project vehicle, this is the SPV. It can be incorporated or unincorporated, but it is registered in the country where you're going to do the project as the party who's going to implement and operate that project. Okay. Procurer, this normally if you have P2P, public project, and normally the procurer will be the government, whether municipality or council or government agency responsible for tendering the project to the private sector. And they run the tender competition, they evaluate proposals, select the preferred sponsor of the consortium. This is if you have P2P, the arrangement, then you will have procurer. Construction contractors, these are the entity that build the project under an engineering procurement and construction or EPC contract. And then you have the government. So the government may contractually provide a number of undertakings or credit support to the sponsor. So this is where you can have some kind of limited recourse to those undertaking or credit support given by the government under a concession agreement. Off-taker, this is normally found in utility, industrial, oil and gas and petrochemical projects. Basically, these are the parties who contractually undertake to purchase the produce the product or services under the project. Who's going to actually buy or purchase the electricity or buy the petroleum generated? Okay, so this would be the off-taker. Okay, so off-taker contract would actually provide strength because it's the payment by the off-taker which will later become the future cash flow of the project. And of course, the financiers or lenders, typically one or more commercial bank or even multilateral agencies or export credit agencies or even bondholders. In the case of Islamic, it would be sukuk holders. So they would be the financiers. Like for example, we have export credit agencies like this one is Exim Bank, Japan, UK, France, and whatnot. So this is for global projects, project financing. So they would become typically the financier, the export credit agencies. Okay. Any questions so far? Okay. So that is for project financing in general. So let's now look at Islamic project financing. Okay. How is it same or different from conventional project finance? So in general, it is still the same in terms of the main feature, financing to assist owner of project to complete project. But the main thing that differentiates Islamic from the conventional would be the, there's no pointer, would be the Sharia principles. So for Islamic project finance, it must comply with the Sharia principles. So if you look at the definition down there, Islamic project financing is a scheme to finance cost of construction or manufacturing, as the case may be, whereby mode and also purpose of financing are Sharia compliant. Okay, so that means the transaction contract to finance are Sharia compliant, and the purpose of the project also Sharia compliant. So if you're doing a project which is not Sharia compliant, let's say the project is actually to develop and construct, let's say, a casino. Okay, so the casino, as you know, involve gambling, which is prohibited under Islamic principles. So that would not be qualified for Islamic project financing. And then the contract used cannot be a loan with interest, because that would be riba. It has to be other type of contracts, which is Sharia compliant. Okay. So purpose must be Sharia compliant. Technique and instruments must be Sharia compliant from the concept, structure, documentation, execution, and implementation, as well as recovery mechanism. Later, if there's problem, default, when you want to recover the amount from the project company, there must also be observation of Sharia compliance as well. Okay. So it must not just be a mere debt leverage exercise, so not just a loan with interest charges. That will not be Sharia compliant because the interest charges is considered as riba, which is prohibited under Islamic principles. I think in the morning, Prof has gone through with you, right, on the prohibitions and whatnot. Okay. Okay. Now on the financing structure, there can be actually many choices, various structures that you can choose from. So it's a bit different from conventional. Conventional is always a loan contract, full stop. But for Islamic, you have a choice whether you want to go for debt-based financing. You can also choose the equity-based financing structure. Okay, so there's two broad choice, whether debt or equity. And then the contract use, if you go for debt, you can have either murabahah, or you can have istisna, you can have ijara. If you go for equity, you can go for mudarabah or musyarakah. Now they have also wakalah. So there can be different or a variety of contracts that you can choose from to underlie the financing structure. And like I mentioned earlier, an important requirement is that the project must be Sharia compliant. Okay. These are the key points to consider before you can choose or decide to choose which contract would be suitable for your project. Okay, for example, are you going to finance an asset that already exists, or are you going to finance a project where the asset is not yet there that you're going to construct when you do that project? So that would have a different repercussion, which contract you're going to use. If the asset exists, or if the asset still under construction, so that will actually tell you whether you're going to choose murabahah or you're going to choose istisna, for example. Okay. And then another thing that you need to consider, finally, who's going to own the asset? During construction, who's expected to own the asset? Is it the project company, or is it the government entity who give you the award? Okay. And then who's going to own after the construction? During construction, who's going to own? After construction, who's going to own? So that's going to determine whether you want to do the normal back-to-back or parallel istisna, or you want to do the back-to-back but reverse istisna where you have ijara elements. Okay, so that would actually be determined on consideration of this feature. What do you want to achieve by that in the project in terms of ownership during construction, also after construction. And then based on that, then you will have to figure out what are the contractual relationship that you are comfortable with when you do the financing. Whether you want to have buying-selling kind of relationship between the project owner and the financier, buying and selling, or you want to do lessor-lessee relationship, or you want to do a partnership kind of relationship. Okay, so these are also key points to be considered, because each of that will require or would have different set of rights and liabilities. Yeah, okay. Like buying and selling, you just buy and sell assets, but the asset must be in existence. If not in existence, you have to do on construction purchase. Okay, so different set of rules. But at the end of the day, after you sold, then you don't have ownership of the asset anymore. So if you require ownership, you cannot sell. You may have to go for leasing so that you can retain ownership, but at the same time, you have to lease it out to get the cash flow, right? But if you're leasing, you still have ownership of the asset. You take ownership risk together with the leasing structure. Partners, it behaves more like equity. There's no debt relationship, whether that is suitable with your objectives in the financing or not. So that's something that you may want to consider. If it involves asset under construction, one of the key points to be considered is what if there is abandonment of the construction. Construction cannot proceed, or construction proceed but doesn't meet the specs. So these are the things that need to be considered. And then what happens if a default happens after completion of the asset? Okay. And then in terms of recourse, what kind of recourse that you want to have if the default happens during construction or if the default happens after construction. So all these are key points that you need to consider to make sure that you choose the correct contract, choose the correct transaction structure, put in the necessary credit enhancements or security that would be necessary for you to meet your requirements lah, okay, that you have identified when you do the consideration initially. Okay. Are you still okay? I need to check a couple of times because it's after lunch. Okay. Susah nak buka eh. I need a stronger person to do this for me. Can you do it for me? Oh, okay. Thank you. Senang je. Oops. What are the other things to be considered? Okay. Like I said earlier, project finance are normally capital intensive. So normally you would need some kind of syndication or consortium. So sometimes there can be also conventional banks, coming together, joining in the consortium. So if they're conventional banks, are they willing to agree to some of the Islamic terms that you may have to include in the documents, right, in the agreement? So that would also be a consideration. So that's why sometimes we see some project finance, they have two tranches, Islamic tranche and conventional tranche, because sometimes they cannot agree to have like a common document that applies to both Islamic and conventional. Okay, so that is also something that that the parties may want to consider. And if there are two tranches, how do we treat the securities? Okay, let's say the first tranche is Islamic, the second tranche is conventional. But you have all these securities that belong to the first tranche. Beneficially, ownership of that securities is with the Islamic banks. How would the conventional banks look at that scenario? Okay, yeah, so that is another thing that you may want to consider. Okay, and then of course, whether the assets are used for Sharia compliant purposes or not, and whether there is excessive debt funding, whether excessive debt funding is an issue for Islamic financing or not. Okay, and if the conventional debt is larger than Islamic financing, is that also an issue in terms of Sharia compliance? Okay, if you have tranches. Okay. So there are some sensitivity there. So some, if you do Islamic financing using equity, this may be a concern because you're going to be owner of that company and the company shouldn't be highly leveraged in a conventional way. That's considered as non-acceptable. Okay, so let's now look at the Islamic project financing in terms of the instruments and contracts. This is more specific and more detailed. So if you look at the financing, you can have like bridging, main financing, syndication, and tranches if needed. And you can also use Islamic Securities or Sukuk as part of fundraising to finance that project. And the underlying contract that can be chosen, you can have Rabiah, you can have istisna. Now they have a lot of tawarruk or commodity Rabiah. You can have also ijarah or ijarah mutahabit tamlik, ijarah masufa fi zimmah, musyarakah or even musyarakah mutanaqisah and mudarabah. I think you are familiar with these contracts, or do you want me to explain? You have done this before the lunch break, the contracts. You know what they are? The difference between ijarah and ijarah masufa fi zimmah, for example. Do you know ijarah masufa fi zimmah? Forward list, yeah. So for the ijarah or ijarah mutahabit tamlik is list of existing assets. You go for ijarah mausufa fi zimmah, asset not yet constructed. You're going to have the asset constructed, then only the lease will start. Or I mean, you enter the lease contract now, but the lease will only take effect after the completion of the construction. That's Ujarah Mausufah. It's like forward lease. Okay? You clear? Okay. Istisna is construction contract. So it's a sale contract. It's still a sale contract. But under normal sale, asset already ready. So you buy and sell a ready asset. But istisna is a special form of sale where asset still under construction. So the seller sells an asset which the seller undertakes to construct according to the specification given by the buyer. Okay, so that is istisna. So under istisna contract, istisna. Okay, for those of you who can read Arabic, istisna. Okay, sin, ta, sod, nun, alif, ain. Okay, so it comes from the word sona'a. Sona'a. Sona'a means construct or manufacture. So under istisna, you have the buyer. So the buyer is known as mustasna. Mustasna, the person who asked for the construction. You have the seller, who is the sona, the manufacturer. Okay. So basically, the contract is about buying and selling of asset. But the asset is still under construction where the seller is going to construct. But the main feature is the buyer will give the specification, the specs of the asset to be constructed. So the construction will meet the spec given by the buyer. So the seller will do the construction as per the specification given by the buyer. So this is what we call istisna contract. Are you clear? Yeah. So in a project financing, normally we will have not just one istisna. We can have normally two istisna if you use istisna. Okay. We call it parallel istisna. Parallel, or sometimes they call it back to back. Because you have the financier as the intermediary. So you have the party enter into istisna with the financier, and then financier enter into istisna with the actual contractor. So they can be very structured. I will inform later when we do on the detailed structure. Are you clear, Nuriza? Yeah. Yeah.
What do you mean by main financing?
Main financing, okay. This is like if you do like bridging, you have bridging and then you have main. So let's say once you have this project, you may want to have a bridger first, let's say to pay the initial cost of that project. Okay, and then you have the main financing for the main construction. Yeah. Yeah, just normally a bridger is to kickstart and then you have the main financing. And the main financing can be broken up into tranches if needed. Yeah.
For the project is main financing, for example?
No. Normally, what do you mean by working capital here?
Meaning providing the funds to start off.
To start off, normally like bridger. Maybe you want to, because when you have a project, the company may already have encumbrance, let's say, on the land they are going to build the asset. So you need to have a bridger to pay off the obligation on that land, so that the land will be free from encumbrance, for example. And then to do the construction, then that's the main one where you would require for the main financing. This is especially when you have some things, but sometimes you just do one kind of the whole thing under the main financer. You don't need a bridger, so everything about the project you just do as the main financing. Yeah, it depends on the actual unique requirements of the parties. Okay, yeah. Both of you are from?
Just a question. Is I mean, because financing is a different sukuk and financing. I mean, same, but there are choices, right? So
Mm.
when is is advisable to
Yeah. Again, that's also very much driven by the individual requirements of the parties involved. Generally, if you go for sukuk issuance, one of course is must be syariah compliant project lah kan. And then for sukuk issuance, depending on the market as well, there are certain times where the market is good for issuance of sukuk. Maybe it's cheaper than direct financing. Why cheaper? Because there's a lot of demand, so there'll be more investors, so there'll be tighter pricing. And then for the investors also, when they go for sukuk, they are not like locked for the financing. Because like project finance can be like 10 years, 15 years. So if you go for sukuk, because it's tradable, so the sukuk holders also have this flexibility of exiting by selling their sukuk on the secondary market, right? So that would also be something that would be considered by the parties. But if you go for sukuk in order to get that good price and the investors interested, then the project must be good, cash flow and whatnots, and then um, what do you call this? The cost of issuing a sukuk is perhaps higher as compared to the normal direct financing, right? So because you have to pay to a lot of parties involved in this sukuk issuance. So that would be another consideration. If you get a better pricing and it actually worthwhile for the issuer to actually pay for the initial cost of sukuk issuance, then they would normally go for sukuk. So more or less commercial reasons, and then security and then credit. Because you'll be having normally for corporates, they would have credit rating, they will be credit rated. So all those things need to be considered lah. So whether you are willing to give all your information.
high-end project?
Uh, I would say that, I mean, not necessarily, but the amount to be raised normally is a bit, I mean, but of course, project finance normally is capital intensive, so it's already a big amount. If it's too small, it doesn't make sense for you to pay the upfront cost if you're just raising like a couple millions. So normally it's in the hundreds of millions or even half billion kind of thing, or billions, because you have initial cost. And I don't know, in terms of tax savings, maybe there are people who are expert in tax. Some structure can also result in some kind of tax savings, or some can be more expensive. Off balance, you can structure off balance sheet, on balance sheet. Yeah, so these are more of commercial reasons. The parties would actually be able to decide. Normally, they will speak to their bank. Huh? Lead arranger lah, the bank who's going to do the lead arrangement. So the bank will advise them on the pro and cons, because the bank would also do their market survey lah, in terms of investor appetite, in terms of the rates, in terms of the kind of security that maybe they want to have, in terms of initial credit rating that they're gauging, all those things. And then they will decide like whether it's better to have issue a sukuk or just do the normal corporate finance, but break it up into different shorter tenure, like that kind of thing. Yeah. Yeah.
If a bridging financing or main financing have different tranches, means for example 2 tranche, can the financier lender use a different underlying contract?
They can. They can have different underlying contract. They can even have different investors. First tranche different investors, second tranche different investors.
Prof, one last question
Yeah.
for now.
Yeah, you can have more questions, no problem.
Sorry, big question, but I just want to understand better. What's the difference between project financing and contract financing? Is there any difference?
Yeah, we have our, yeah, can you explain, share with us the difference between contract financing and project financing?
Debt financing is normally the what the very much long term. Contract financing will be shorter. It's a working capital base.
Yeah. Thank you very much, Cik Mahathir, for that. He's our experienced banker who has a lot of experience in this. Yeah. I hope that answers your questions.
So experience as well, my limited
Mhm.
experience. I do see that if it's a project financing, the security is quite different than contract financing.
Yeah. Yeah, it's different.
Project financing is different. Like
the PPA, the rights under the PPA put aside to the bank.
Yeah.
As for contract financing, it's just the contract proceeds. That's it.
Yeah,
The
yeah.
documentation will not, the rights under documentation will not be assigned.
Yeah.
So that's why I'm trying to understand from the bank's perspective, is there a difference between project?
There is, it seems, yeah.
Yeah,
Our banker says there's a difference, yeah, in terms of tenure, in terms of purpose, even, yeah.
Thank you.
Oh, where did I put the clicker? Not with you. Oh, whiteboard. Okay. I need to put it in my other pocket then. Okay. Okay, so these are the more detailed explanation. Bridging is common for project financing, but also equally applicable for but normally on a smaller scale, basically. Basically, this is like shorter period before you kickstart with the main project. I think I've responded to the earlier question just now. And the syndication normally will come at the main project financing. Okay. Revolving is another possibility, especially if you have like a kind of project that requires different amount of cash flow at various different timing, because it prevents negative carry. If you do like one go, you may have negative carry of the big sum. So you can have it like revolving. So as you need the amount for the project, you will do the withdrawal, or you request for the amount to be released. And then as you pay, it will revolving. So you have the limit. You have the limit. So that's the revolving feature that is also possible to address the different requirements for different phases of the construction. Okay. Now let's look at the example of some of the transaction structures. If you look at the Islamic project financing, actually there are maybe what I can say like kind of evolution of the different structures that they are using for the purpose of Islamic project financing. In the initial years, if you remember, in the 90s, early 2000, Malaysia has a lot of project finance, right? We have like the Putrajaya, where we develop Putrajaya who they wanted to build all those government offices at Putrajaya. So they did a lot of project finance. And then we have a lot of this power plant development, Tanjung Bin, a lot of this power plant going from hydro, and then now they wanted to do like solar. Okay, so these are all examples of project finance. So when we did the LRT, KLIA, initially all using debt-based sale contracts. So we had a lot of instruments in the 90s and also early 2000. Basically all are Murabaha and BBA. BBA papers, BBA financing, Murabaha financing. We have some istisna also, involving construction, like we have the Sarawak Specialist Hospital. Last time we used istisna. Tanjung Bin Power Plant used istisna. A number of transactions also use istisna contract. But we have also some ijarah. Basically, ijarah comes slightly later, 2002, 2003 onwards, then we started to have ijarah structures. And then 2004, 2005, we have mudarabah and also musyarakah structures as well for project financing. Okay. Later trends, they have more complex, liquid, competitively priced instruments like they use sukuk, and they can have like combination. They have istisna ijarah, musyarakah istisna ijarah. Okay, so they have combinations of contracts to address the different stage of the project lah. They have musyarakah to get the money, they have istisna to do the construction, they have ijarah to lease the completed asset, for example. So basically the financing structure can can change, can be continuously developed depending on the needs and also the nature of the project itself. Basically, if you go for the sale-based project finance, from the perspective of the financier, this is something which they are more familiar with, because as a financier, even those who are trained in the conventional banking system, you have a loan contract, okay, lending and borrowing. So it's a debt, fixed instrument, fixed income instrument, fixed rate. Easy, right? So if you do BBA Murabaha, it's actually fixed return type, fixed price. So in terms of behavior, it is very close to the behavior of the loan. But it's a sale contract, so you need to have asset that you need to sell and buy. Loan, you don't need to have asset, right? So here you need to have an asset that you can buy and sell. So if you have asset that is ready to be bought and sold, then BBA Murabaha would be a good choice. The problem with sale contract is when for project finance, normally you don't have the asset yet. Asset is to be constructed under the project. So at the start, when you want to get financing, you don't have asset. So if you don't have asset, technically, you cannot go for BBA or Murabaha. But now they have this commodity Murabaha or Tawarruk, which actually allow you to leverage on the asset on the Bursa commodity house. Okay, so you buy commodity at Bursa from the financier at a Murabaha basis. So you don't need to have your own asset. Okay, but I will show to you later the details on that. In the past, you also use istisna. You can do construction contract if you don't have asset yet. You're going to construct it in the future. You can also have forward lease if you don't have asset yet, using forward leasing. Okay, sorry if I make you a bit cracking your head, because I know it's hard to think in a very technical way at this hour. So I will show to you the first one, basically project financing using a simple Murabaha contract. So this would be, let's say, suitable maybe for bridging. You want to kickstart, you want to have all your raw materials, you want to buy your raw materials for the construction. So you can go to the bank and financier to release the first part of the financing for you to purchase equipments and also raw materials for you to start the construction. So you identify your equipments, your raw materials. Let's say you want to build hospitals, specialist hospitals. So you actually get a financier to buy those materials, equipments that you have identified with the supplier that you have identified, and then they will sell it to the project company with a markup. So Murabaha, I think you're familiar, right, with Murabaha? Basically means sale with a markup. Okay. Rabaha. So they say here Rabaha. Rabaha means making profit. So in a Murabaha, you have a sale with a markup. So the financier bought the asset. Let's say the price of the asset is 10 million from the supplier. This is the cost price. And then the financier would sell it to the project company with a markup. Okay, so sell to the project company 10 million plus profit or markup. And this Murabaha price is to be paid on deferred payment terms. Okay, so as simple as that. So because it's a bridger, maybe you do the initial phase, maybe like just short term or medium term to pay that initial cost. Okay, are you clear? Deferred payment of the sale price with a profit margin to the financier. This is if you are still not sure which asset that you want to buy, or you just need some kind of cash to pay miscellaneous thing that you cannot really identify as asset ready to be purchased by the financier. Sometimes when you want to do a project, there are things you have to pay for certain rights and all those things, okay, like even to pay for your to clear the encumbrances on your asset and whatnot. So commodity murabaha is perhaps easier because it allows the company or the project company to have cash without having to have their own asset as yet. So in this example, let's say actually you have this project company. Project company needs $10 million, for example. Project company goes to the financier, tells the financier we need 10 million to kickstart the project. We don't have any suitable asset that we can identify or whatever. So we need 10 million. So the bank say, okay, we will do commodity murabaha with you. So we will buy commodity from any commodity provider. Let's say because we are, this is US dollars. So I'm giving the example of London Metal Exchange. So LME, London Metal Exchange. You can also buy from Bursa Malaysia. Bursa Malaysia also facilitate US dollar. So you can buy from BISAS, Bursa Suk Asila, or you can buy CPO assets from BISAS. You can buy metal on LME worth $10 million. Okay. So the bank will buy the commodity, $10 million, sell to the customer on 10 million plus a markup. So let's say it's payable over a 2-year deferred payment basis. Okay. So this customer or project company actually needs cash, right? 10 million. So they get the commodity. So they sell it to another party to get the 10 million that they need. So what this company is doing actually is, project company is doing tawarruk. Okay? Tawarruk. I hope you are familiar with tawarruk. Yeah, maybe just to refresh. Tawarruk. So CM is commodity murabaha because you're using commodity and murabaha, but tawarruk is actually literally means monetize because it comes from the word warik. Warik means money. Tawarruk, you make money from the transaction. So in this case, the project company is the party needing money. So this project company don't have cash, don't have suitable assets. So they will have to buy assets. And then to generate money, they need to sell the asset. So in our example, project company buys asset from financier. And financiers sell it to them on murabaha. Okay. So project company sells asset to a third party. There's another party here to get cash. Okay. So at the end of that transaction, you can see that project company is getting 10 million. Okay. So gets 10 million. I don't have pointer. 10 million. And then over 2 years, pay to the bank the 10 million. It can be one bullet at the end of 2 years also can. So 10 million plus profit to the bank after receiving cash from another party, from the market. Okay? Are you clear?
It's a single agency.
It can be done as single agency. It can be also done with separate agents. Like if you go for BISAS, normally it's like single agency where you go to the bank will buy, and bank is the agent for you to sell to the third party. Yeah, because normally the project company may not be having access to do the trading on the exchange, maybe LME or BISAS. So the registered trader on BISAS would be like, say, normally the bank lah. So the bank will be the agent of the customer to sell to the third party later. Okay? Are you clear? So basically at the end of that transaction, the customer gets the 10 million financing that they need. You see the middle there, where the project company gets 10 million and they can use it for the purpose of the project. And then on 2 years deferred payment basis, they're going to pay the bank the 10 million plus profit to the bank. Yes. Yeah.
It's more than that.
Mm.
But maybe then
Yeah. There's possibility of you sell it at a premium, but I'm not sure about LME, but at Bursa, at Bisas, that possibility is quite slim, because when they buy from the broker, they are buying slightly at a discounted from market. From broker A, yeah. So when you sell also, there's some kind of arrangement between the brokers that there would be a certain price. If you do on the same day, the same price purchase and also sell. But if you sell on the open market, because you're actually buying at some kind of less than the market price, then the possibility of you being able to sell at a premium outside would be minimal. But let's say suddenly there's some kind of unusual movement of the price, so you can buy from Bisas at Lake 3, and then you find that actually there's another buyer outside who is willing to buy at a premium, you can sell. Yeah, project company. They did consider it. I remember one time Bursa was considering another commodity, not CPO. There was another commodity. And it seems that for that commodity, because of the pricing, there is a possibility after you purchase from the initial buyer, you may potentially be able to sell it on the open market at a higher price. No issue. Because the requirement from Sharia perspective is the sale must be real. So you buy, you have the ability as a buyer to take delivery of the asset, and then you don't even have to sell it to get the 10 million. You can maybe take it and use it, or you can sell to another party, not necessarily on the exchange.
the trading with the company.
It depends on the platform. I'm not that sure about LME, but Bursa, they have certain time period that you need to confirm whether you are going to sell on, or if you don't at a certain cut off period, the asset is considered as to be delivered to you. Right? So if you want to actually sell on and don't want to have all the cost of taking delivery, then they have to make sure that they sell within certain period of time. If not, the asset then will be confirmed and then delivered to the buyer. Okay? Is that clear? Okay. Istisna. This is another possible structure where there's no ready asset for buying and selling, and you want to do construction. You have the specs, so you can use istisna contract. Like I said, you can do parallel, back-to-back istisna, including the customer, financier, and contractor. And it can also be designed in blocks to meet different phases of the construction and can have the effect of revolving financing mechanism. So to illustrate this, now before we go to the illustration, just to show to you, we have actually policy documents issued by Bank Negara on each of the contracts that we have mentioned earlier. Like even we have policy document on Murabaha, basically a Sharia standard on Murabaha. We have policy document on Ijara, Istisna. So I'm just highlighting to you on the Istisna that in terms of, just to clarify, because under Murabaha is clear, once you sell, ownership of the asset belongs to the buyer, right? But under Istisna, because asset is under construction, so there is a gap, right? During construction, who actually owns the asset? So under the policy document by Bank Negara, under standard 15.1, it says that pending delivery of Istisna asset, ownership remains with the seller. Although it's a sale contract, you have sold your asset, but because asset still under construction, during construction and prior to delivery of the asset to the buyer, ownership still with the seller. Okay? Ownership of istisna asset must transfer from seller to purchaser upon purchaser taking possession. So once the purchaser take possession of the istisna asset, meeting the agreed specification, then ownership will be transferred to the buyer. Okay. Purchaser must not sell istisna asset to another party prior to taking actual or constructive possession. Because you don't have ownership yet during construction and before taking possession, then the buyer cannot sell it before that because they don't have ownership. Ownership only transfer to the buyer after taking delivery. Okay, so this is just to clarify because it's different from the normal sale contract. And then what if the asset actually is, I mean, if you look at G, 15.6 is G. S is standard, is mandatory. G means optional, just a guide. So this is, let's say, if you are not so sure about successful completion of the asset as per the specification, then they may agree that purchaser may take possession of the istisna asset under construction on as-is basis. Okay, because like there's some delay and you need to actually sell on a certain portion of the istisna asset. So you will just take possession of the portion that is completed as is basis, and then you have ownership, you can sell it off. So the remaining still belong to the contractor, the seller, okay? And then you have to agree on when and how to deliver that portion. So this is to provide more flexibility. This is G, is a guide. If they want, they can have that. If not, then generally you take it as a whole and you will not have ownership as yet until you actually take delivery of the full asset. Okay? Yeah. Like you want to have something to ask? Yeah.
I'm just wondering if, for example, the
Uh-huh.
project is building a housing project,
Yeah.
and the payment of the main construction is by selling the property to prospective house buyer.
Mhm.
Can they use is not in that housing project whereby you need to deliver the project to the customer?
Yeah, you can
Before-
also have istisna for home financing project with the end buyer, with the end buyer, right, with the customer. So in this situation, normally, but I don't know whether developer would be agreeable to that lah, because then it would be the developer selling the asset to the bank and the bank selling the asset to the customer. Yeah. So some developer do not like to have the idea of the bank being their buyer because the bank will be more rigorous in checking the progress of the project as compared to the buyer. I know there have been some doing using istisna. If I'm not mistaken, it was Quick Finance House for Pavilion project. So they do this parallel because you need to have a good developer who is credible enough that they don't mind dealing with the banks and the release of money from the bank upon their successful completion. And the bank is also comfortable to take the risk of that developer. So the bank is buying from developer and then the bank sells to the end purchaser with a markup. Okay, what I know, most developer not really comfortable. They are more comfortable dealing with the customer lah, and then customer deal with the bank. So that's why normally what the customer did, if that is the case, then they will just do the commodity murabaha, the customer get cash and pay to their developer. But if developer is credible enough, you can have actually istisna. The bank buys from developer and then the bank sells to the customer with the markup. Okay, yeah. Yes.
I'm sure it will be the seller, right? Also the mustasnad, the one who will construct it.
Okay. It depends. If you look at the istisna financing, the back to back, you can have the like you said. So the bank will be selling to the customer. So the bank will be the contract sonnet, but at the same time, the bank will also be mustasnad. The bank is going to buy from the actual contractor, right? So the bank take the risk of that contractor, and then the customer take the risk of the bank delivery, right? So these two contracts must be standalone lah, independent. Okay, but there's also another structure where they do reverse because the bank is not comfortable to take the risk of the contractor. So I think there is can we go to the next slide so that I can show to you, and then you can ask any question after that. Okay. So let me show to you. Okay. This is the parallel. Is this not the normal one? So you can see that this company here is the one who is, let's say, the project company who wants to get the construction done. So they will go to the bank to get the financing. So they have this project. Let's say the project is to construct vessels, ships, for shipping, ships. And the price of the ship. Anyone who knows what's the price of a vessel, a ship for oil and gas? Cik Mahathir, you know, roughly price of vessel for oil and gas? $60 million. $60 million. So that's the cost, and then the bank's markup. Maybe the bank selling to the customer $70 million USD. And then the bank will actually enter into another istisna with the actual contractor who's going to build the ship. Well-known, renowned shipbuilder lah. Okay, so $60 million here, 70 million markup basis with the customer. So customer going to pay deferred, and the bank going to pay progressive with the shipbuilder. Okay, very clear cut. So in this situation, when the bank is comfortable with the contractor, the bank would be maybe willing to do that. What I know for Pavilion, some of that portion of the Pavilion construction, Quick Finance House did istisna, parallel istisna. Okay, because these are big developer, they are comfortable. Okay, so what is important from Sharia compliant perspective, these two contracts must be independent, stand-alone. Although the spec can be 100% the same, but they must be stand-alone. They cannot be linked to each other, not two in one. It's two separate independent contracts. Okay? Yeah. Another one, the one that I said reverse, is when the bank is not that comfortable with the contractor for some reason or another. So reverse is not the bank actually wants to deal with the customer. So the bank will actually become the buyer, buying the asset under construction from the customer. Okay? And the customer will actually enter into the actual istisna with the contractor. Okay? Okay, customer enter with the contractor, pay progressively, the bank buys from the customer, pay progressively. So the bank payment will match with the payment to the contractor. But still, they must be stand-alone independent contracts. But after that, you can see who owns the asset. Customer buy from contractor and the customer sells to the bank. So the bank will finally own the asset, right, after completion of the construction. So in this reverse istisna, you will have ijara. The third leg is ijara. So the bank leases the asset to the customer. So whether the payment of the ijara will start during construction or after completion, this will determine which type of ijara you're going to use. So some of the project, the bank say, okay, zero payment during construction. So no ijara during construction. Upon completion, then you start the ijara. So you do the normal ijara, mutahiyah bitamlik. So ijara, let's say for 10 years. Then after that, you will transfer the asset to the customer via the sale or hibah, mutahiyah bitamlik, right? But if the bank wants to start with the payment of the rental during construction, you can have ijara mausufa fi zimma, forward lease with the customer. You enter the ijara now, asset will be delivered in the future, enjoyment of the asset will be in the future, but you start charging the rental payment from the customer during that construction period. Okay, so this is another section. So do you have any further question, Arija?
For istisna, for additional istisna, if the ship did not meet the expectation or the specs.
Mhm.
So the seller may not, the buyer may not
Mm.
get paid.
Yeah.
So how to
Yeah. Normally, you will have to actually put in the building contract, the construction contract, The terms and condition lah, basically spec, variation order, additional cost, delay in delivery. So all of that, you need to have a construction lawyer to draft the agreement properly so that the right of the buyer is actually adequately protected. And then you have warranty period and all those things that will be under the istisna contract, under the construction contract. Yeah. It's still there. You see, the construction contract should be like the normal thing that you do in order to protect the interest of the buyer.
So the bank didn't construct,
Yes.
just appoint the
Yeah. Yeah.
So if the faults on the
Yeah, that's why the bank do the construction also. You can see the bank enter into construction contract with the contractor under the first one, right? The first structure. So the bank will have the right to enforce that contract against the contractor. Mm.
so there is another agreement between the bank and the
This one, the istisna 2 just now. Yeah. So all the right, the bank will enforce against the contractor. Normally, in this situation, the bank will have performance bond. There will be security given by the contractor to the bank. A lot of measures lah, actually. Anything problem with the project, the bank can recourse on the performance bond and the collateral.
there will be two independent contracts.
Yeah.
So what if one of the because there is two, it shouldn't
It shouldn't affect the other contract. So let's say, under the first istisna, the contractor actually defaulted. So the bank may appoint another contractor and recover what they can from the first contractor. Right.
so they can play their part.
They have to.
Not
So if you have this kind of thing, normally the bank would have to have their project manager. They will have to employ people with the necessary skill set to understand project financing and the constructions as well. Yeah. So this is an example of the project finance of the one using Rabiah. This one, the straightforward one I was mentioning just now. This is Hub River project in Pakistan. The total fund required was 1.8 billion US dollar. And the initial $92 million Islamic project finance was financed by Rajhi Investment Company of Riyadh. Okay, so they actually financed the initial purchase of equipment on Murabaha basis. Okay, so they bought equipment from the third party, basically the turbines for the hydro on a istisna basis, and they sell those equipments to the project company on Murabaha basis after satisfactory delivery of the asset. Okay, so this example of Murabaha. And the other one is on istisna project financing. This was an example case study of the Tanjung Bin istisna, and they structure this as a sukuk issuance. MTN, medium term notes. Basically, that means it's a series, multiple drawdown of the amount under the sukuk to match the different tranche of the construction of the power plant. And the istisna back to back, but for this one, because this was done in the 90s, 90s or early 2000, where they still do the istisna back to back with the same party. Basically, more like Ba'al-Inah, but using istisna. Ba'al-Inah structure in an istisna form. So that means you don't have, like our example just now, you have bank buy from contractor, bank sell to customer. Now it's bank buy from company and sell also to the company. Okay, so what happens is actually the financier, basically financier here is like SPV on behalf of the investors, of sukuk holders. They will actually buy, basically it's not purchase agreement to buy the asset under construction from the issuer. So that would be that tranche of the power plant. Okay, they buy from the company, from the project company, the issuer. And the price would be like a few hundred million, disbursed in one lump sum. So the first istisna, where the financier buy from the project company, issuer will be paying one lump sum. So project company get, let's say 100 million, and they're going to use that for that phase of that project. And then they enter into the second istisna, where project company now will, the financier then will sell that similar spec of that tranche to the project company with a markup price. Is this not sale price? But this one will be paid deferred payment, and the deferred payment is evidenced by the sukuk. Okay, so the istisna sukuk represent the price under the second istisna sale contract between the financier and the issuer. Okay, so the total raise was supposed to be 5.6 billion ringgit. But for every issuance would be a few hundred million, and then they need another tranche, another few hundred million, until the total amount of the project was 5.6 billion ringgit. Okay? Are you okay? Yeah. Yeah, by enough structure.
Not mistaken by Ina, can't use under construction.
It is istisna, but it is istisna contract, but back to back with the same party. Yeah. It's a controversial structure lah. After this, I think we did a few. I mean, in Malaysia, we have a few of this structure, and after that, as even by Aina also, we have stopped, right? So this structure is no longer. I don't think we have a repeat of this structure because of the controversy of Pak Aina, and then they also actually make the sukuk tradable from day one. Whereas, as you know, under the Negara policy document istisna, if the asset under construction, you cannot, sell the asset yet. And then because this represent the price of the istisna sale, but if the istisna asset has not been delivered, the price is not sabit yet. It's not confirmed, not mustakir. So it's done ghairu mustakir. So it shouldn't be tradable from day one. Okay, so those are some of the issues. But just putting it here to show to you that it had been done in this way before, but I don't think this kind of structure can be repeated, like back to back with the same party in the future because of the Sharia issues involved. Okay. Another alternative is actually you can have project financing using lease contract. This is perhaps, in terms of Sharia compliance, is perhaps better because there's no enough. And there's also perhaps the issue of debt is less. When you do sukuk, the sukuk no longer represent pure debt. It's representing the asset under leasing. Okay, so it's easier to do the buying and selling because it's no longer the issue of ba'dain, sale of debt. Okay, so this is actually an increasingly preferred structure for medium to long-term financing, suitable very much for equipment especially. It is less controversial if you want to do floating rate arrangement. It's easier to structure floating rates under Ijara. And you can use it to raise fund for project finance. It can also be structured via sukuk, and it can also you can do actually sale and leaseback arrangement. You can do operating lease, financial lease, and also forward lease. So this is a simple illustration, basic lease-based project financing. So in this type of structure, the project company must have an asset that is suitable for leasing. So in terms of the constraint of lease-based project financing is it is very, very heavy on asset. If you don't have suitable asset to lease, it doesn't work. So you must have an asset that you can lease out. So let's say this company has an asset, company has land which is unencumbered. So company can sell the land to the bank or to the financiers. Financiers bought the land and then financier lease out to the company. So when financier bought the land, financier pay the lump sum, which is the amount to be raised to fund the project. Okay, so financier sell the land and got 100 million. 100 million can be used for the purpose of the project. Or sell the land, get 1 billion, or sell land together with factory or whatever, and then you get 1 billion, and then you can use that 1 billion for the project. Okay? Or you can actually sell your asset, which is another piece of land elsewhere. You have already an existing hydro plant or whatever completed. You sell it, get the cash, use the cash for the new construction of a new power plant. And then you lease the one that you have sold from the financier, and you pay rental to the financier. So the rental will consist of the financier's profit and also return of principal later. Okay, so that is using lease. So you have a sale of the asset, and then financier lease it back to the project company, and that's where the financier gets their profit and principal. Okay. Any question? Okay. This is an example of Equate petrochemical plant in Kuwait. This was using Ijara. There was no sukuk in this transaction. It's a normal syndicated financing of that project. The total funding required was 2 billion US dollars. This was in the 90s, 2 billion US dollars. So they break up the project into 3 tranches, basically to build 3 petrochemical plants in the Shuaibah area in Kuwait. Each plant has its own engineering, procurement, and construction contractor. And actually, they have the major portion actually conventional syndicated financing, but they integrate an Islamic tranche worth $200 million. So 200 million out of 2 billion. So it's about 10% only lah, actually using Islamic. So they actually did this under this project, and they use Ijara to fund the Islamic tranche. Basically, financier buy some assets and then lease it to the project company for a period of time. And Ijara was structured as a variable rate instrument. Okay. And then this is another one. Basically, if you want to have Sukuk Ijara, you can also structure the project finance as Sukuk Ijara. So let's say the project company own an asset, sell it to the SPV, and then SPV lease it back to the company. So the sale will actually generate the cash. At first leg, you have the cash. You can use the cash for your project, and then you pay the lease rental to the SPV, who's going to channel it back to the sukuk holders. Okay. At the end of that sukuk, maturity of the sukuk, the company will buy the asset back from the completed the asset back from the sukuk holders. So that's where the sukuk holders will get back their principal investment. Okay. Any question, Alina? Okay. Nabil, yes. Syariah non-compliant issues. I'm not sure whether it's Syariah non-compliant issue, but there are some Syariah opinions about whether you can have purchase undertaking in an Ijarah sukuk for that matter. But the majority opinion allows for purchase undertaking. But for those who do not allow, like for example, like I think Sudanese, if not mistaken, the Sharia opinion in Sudan, when the company sold the asset to SPV, right? And then take it on lease, but the company undertakes to purchase the asset back from the investors, from the SPV representing the investors at a certain price. So this purchase back after you have sold. Okay, so to the Sudanese scholars, they consider this still having the elements of ba'al-inah, because you sell and then you promise to buy back. Although normally ba'al-inah is sell and then buy back, but here you sell and then you promise to buy back. Majority says it's not ba'al-inah because there's a gap of time. Anything can happen during that time. If the asset is destroyed, you cannot buy back. So it's not really ba'al-inah. But for some scholars, they still consider that as ba'al-inah. So they would have an issue lah if you want to do this kind of sukuk ijarah. But most of the other scholars, they are quite okay with that. Okay, okay, Nabil. Okay. Other Syariah issues is basically, let's say, the asset, whether there's real assets capable of being leased out. Okay. This is an example case study of Nakhil. Nakhil development sukuk. Nakhil sukuk. Anyone familiar with Nakhil? The pound. If you have been to Dubai, the pound. Anyone been to Dubai recently? None. They have this waterfront development in Dubai. They call it the pound because it's in the form. Nakhil is the Arabic term for the pound. Because they built the waterfront in the form of a palm tree. So you have the main trunk as the road, and then you have the leaves of the palm, individual waterfront islands where they have high-end accommodation. So they have this the palm project, this Nakhil. They have also the wool where they actually do waterfront in the shape of the wool. So you have Asia, Africa, in the shape of the globe. Okay, but this was their first project, Nakhil, in the form of the palm tree. So you can see the size of the issuance was huge, 3.52 billion US dollar for the purpose of financing the project of the pound, to developing the pound, Nakhil. It was issued in US dollar, format regulation S, meaning that it was issued in US dollar but not meant to be issued and traded in the US. Therefore, doesn't have to follow the SEC rules in the US. Sukuk ijarah, tenure was 3 years. Yield and coupon, this actually reflect the calculation of the rental rate. So rental rate profit for the investors is USD LIBOR plus 120 basis points. So that's actually a floating rate. They review every 3 months or every semi-annually. I couldn't remember, you have to look at the documents. So it's a floating rate paper. It was issued in 2007. You can see that they issued 2007. And then 2008, there was this credit crisis. Okay, so when they issued, it was boom. Okay, but later there was some issue because of the subprime credit crisis that affected the property market and whatnot. So investor distribution, most of them from Middle East, but some from Asia, and also quite a number from Europe and other places. So before we go to the transaction structure, just to explain to you the ownership structure of Nakhil. So you have government of Dubai 100% owning Dubai World, which is the decree company owning Nakhil World. And then Nakhil will have 3 subsidiaries, Nakhil Holding 1, 2, and 3, and together they hold Nakhil Company, Nakhil Public Joint Stock Company. Okay, so the project company is the one at the bottom there, Nakhil. Okay, so although there are various parties involved, but they are actually 100% owned by the Dubai government. Okay, so the transaction structure, we have Nakhil Holding 1 selling land, long leasehold of land to Nakhil Development as the issuer, basically the one at the back, at the bottom there. So they are the one who's going to, the SPV is going to actually develop. So they actually issued a sukuk to the investors. Investors paid 3.52 billion US dollar to buy the land, right to the land. And then the proceeds goes to the Nakil Holding. And then Nakil Holding also, second Nakil Holding become the lessee to pay rental to the SPV. And there's purchase undertaking also by Nakil Holding 2. They are also the purchase undertaking obligor to buy the project assets at the end of the 3 years. And you can see there's a lot of co-obligor there, guarantee by Nakil Holding 1, 2, and 3. There's also guarantee by Dubai World, and there's also share pledge by Nakil Holding 1. Okay. And it's also structured as convertible sukuk. If there is qualifying public offer, there will be QPO shares to be converted. The sukuk will be converted into the QPO shares, mandatory QPO shares if there is QPO, qualifying public offer. So they can convert their sukuk into shares that is being offered to the public lah. Okay. But there was no QPO and whatnot. Actually, there was problem later because of the credit crisis. So there was cash flow problem. There was near default. Near default. I mean, the project was completed, but there was near default because of cash flow problem. But it was bailed out by Abu Dhabi government. So the last minute, Abu Dhabi government wired in money. So they did not defaulted, and there was restructuring. A lot of negotiations, and finally I think school holders get back their money lah quite recently. So it took a long time lah to do restructuring and whatnot to pay off the 3.50 billion.
Is it the one the last conversation?
Actually, it's by the one at the front lah, Nakhil. There was no default, but near default, and it was triggered by the Dubai government saying that they are considering moratorium on the payment for Nakhil. So all the investors panic and say, oh, who are we going to have recourse to? So their lawyers are arguing that maybe we can have recourse to the land because it's Ijara, we technically own the land, but because the land actually own, I mean, legal ownership, legal title still with the king and whatnot. Okay, so there were a lot of practical issues, although technically you own the land, but basically they say, who's going to tell the king that they're going to sell his land? Okay, so there are some practical constraints. So that's why they later go for restructuring and whatnot. But before that, Abu Dhabi government actually bail out. They pay for the obligation for that period, and then they do a restructuring. So we're going to have another example of project finance. Now we went to Dubai. Now we are going flying to Mecca. Okay. After Dubai, we go to Mecca. Another example of project finance. For the Dubai transaction using Ijara, where they have sale of the asset and then they lease it back, and at the end of the tenure, they buy the land parcels back from the investors. For Zamzam Tower, this is in Mecca. They have also lease, but it's a forward lease. They use another structure, forward lease, Ijarah Masufah Fizimah. So this is actually for the purpose of financing projects around in the Haram area, Mecca and Medina. So they have redevelopment of the Waqaf land surrounding the area. So because it's Waqaf land, you cannot really sell the land to the investors. So what they can do, they can lease the land to the investors, okay, and they do a long-term lease. Not to the investors. Initially, they actually have a long leasehold from the Ministry of Awqaf to the contractor, to the lead contractor. So in this case, the company, construction company who got the award to do the construction and development of the area was Munshaat. So as you know, Munshaat is one of the biggest construction development company lah in the Gulf region. one of the Bin Laden Bin Laden group of companies. Okay, so they got this concession under Build, Operate, Transfer (BOT) to build the tower, operate it for the tenure of the leasehold, and then after that transfer the asset back to the Waqaf, to the Ministry of Awqaf. Okay, so for this one, the Zamzam Tower, if you go to Mecca, you can see the clock tower on the side, the Zamzam Tower and the Safwa Tower. Okay, so Zamzam Tower is the one that they wanted to construct, and they issued the sukuk, Zamzam sukuk, to do the construction of the tower. Basically, the issue that they need to look at financing cost of the construction, and then there are some limitation because it's Waqaf land, and also there's restriction on ownership, on the property rights for non-Saudis, and they have investors interested to participate and they are not Saudi. Okay, so they have to do a structure which can overcome these issues. Yes. Yeah.
Putting money, expect some sort of return. So the return, is it just the ability of staying, leasing?
Yeah.
Which is
Yeah. It's a timeshare. The timeshare means that if you don't use or you don't utilize your timeshare, the property manager will lease out to other pilgrims. So the payment from that pilgrim will be credited into your account. Yeah, yeah. So you can have a monetary return as well in the form of the rental for those staying in that building, in the tower, in your slot lah, for your timeshare. Yeah. But I was told by those who are involved that this actually was taken up by investors who are really high net worth, and they are more interested in having the right to stay. If not them, then their family members, and they're not really bothered about monetary returns. But they do get if they don't stay and their family do not stay, and if anyone is staying at that time slot, they're going to get that money after minusing the fee for the property manager. Okay. Yeah. So the transaction or contract that they chose was Ijara Masufa fi Zimmah, forward lease contract, and they use time sharing in order to avoid the issue of non-Saudis to own property rights.
within India, we can different parties.
Okay, I will explain. Basically, the timeshare is actually in the form of timeshare of the units. Okay, so basically, it's like you can choose the sukuk. One sock represent, for example, if I remember correctly, it was 1 week stay. 1 week stay, and you can choose the month and also the type of the asset. The amenities in that asset. Okay, so let's say you're going to choose which floor. Is it suite or deluxe, or so the type of room, and then whether it's going to be a haram view or Kaabah view or city view, different pricing. And the most important criteria is normally the time, whether you're choosing peak season or non-peak season. So let's say we're choosing the first week of Ramadan, will be expensive, and the second, third, final week of Ramadan will be the most expensive, for example. And then if you chose the weeks during Zulhijjah, during the Hajj season, okay, so the time slot. So you choose, so if you, basically these people who subscribe to the school, they are very high net worth, they are just, actually, they don't know where to put their money in. So basically they will just they just want to know that during Ramadan, during Hajj, they have a timeshare in the building. If they are not going, then their family will be going, okay? Or if and none of them are going, then the property manager will open it for other pilgrims to use, and then the payment by the pilgrims will be credited into their account. Okay, so based on pure time sharing, and you choose your time slot and features, dekat mausuf, you have to describe what are the features of the property that you want. Okay, which floor, the kind of the room, how many beds, king size or whatever, and then also the other specific features of the room. Okay. And of course, if you have Kaabah view, more expensive than Haram view. Haram view more expensive than city view. Okay. So what they do, the Wakaf administrator give the long-term leasehold to Munshaat. Initially, it was 24 years. But later when they do the construction, there was a delay, slight delay about 1 year. So they increased the leasehold to 25 years. Because the idea is construction, 2 years, but it took 3 years. And then the use of the asset, the enjoyment, the time use of the timeshare, 22 years. So the period of the forward lease actually 22 years. The leasing period was 22 years, and then the rest, like 2 to 3 years, was actually for the construction. So Munshaat will develop and then operate for that 22 years after construction, and then transfer. It's built, operate, then transfer to the Wakaf at the expiry of the leasehold, expiry of the 25 years. Okay. To finance, they issue the sukuk. So like I said, the sukuk represent the timeshare. So you subscribe, you pay. The payment is construed as advance rental. Advance rental. It's like salam contract. Salam contract, you buy, you pay the price of the goods in cash full, but you take delivery of the goods in the future. Here you pay fully the rental for 22 years use for the time slot that you have chosen. But you're going to get delivery of that usufruct, that right to use or the timeshare after completion and for 22 years. Okay, and this right transferable. So after a few years, you want to sell off that right, you can to any other interested buyer. It can be inherited by the legal heirs if the person dies. So the legal heirs can inherit for the remaining of that 22 years. It can be given as a gift also to the beloved ones, for example. Okay, so that's the time slot, the timeshare. So sukuk holders paid, that was few hundred million US dollar, plus they can also pay in Saudi Riyal, equivalent Saudi Riyal. So developer get the money. Developer issued the sukuk to represent the rights to enjoy the property. So they call it sukuk intifa. So intifa means enjoyment of the utility. So you enjoy the timeshare that you have chosen. Okay, and the money proceeds from the sukuk sold to the investors, used for partly to pay for the lease rental adalah long-term leasehold to the wakaf, but majority of the money actually is used for the construction, for the project financing. Construction of the commercial and hotel complex. Basically, they built the Zamzam Tower, which was already completed many years, quite a number of years ago, right? So people have started to stay there. So the sukuk holders started already to enjoy the time use. If they don't use, basically, it will be leased out to sublease to tenants, pilgrims, okay, and the money will be credited to the relevant sukuk holders. Are you clear? So this is a bit unique because at the end of the tenure, you will exhaust your time use. You don't get you don't get back your payment of the principal or what, basically. So you get the utilization of the property, or if you don't utilize, you get the rental that is paid to that property during that time slot. Okay. Okay. This is another structure where they have a combination of istisna and ijara. They call it istisna ijara structure. It can be used also via sukuk issuance. For example, you have the project company here. Actually, actually getting the funding for the construction through the issuance of istisna ijara. So the issuer issued the sukuk to get the money from the investors, and then this is for the purpose of purchasing the asset under construction. So the issuer enters into istisna with the contractor, basically on behalf of the sukuk holders. And upon completion of the istisna, upon completion of the construction, the asset will be leased to the project company for a rental payment. Okay, so this is the basic structure. I will show to you in the form of the actual transaction where they use istisna ijara to fund the construction of a project. So we are flying back to UAE, United Arab Emirates, for the purpose of looking at Tabreed project. Tabreed is a company in UAE, actually in the GCC. It's a company providing air conditioning, centralized air conditioning for the GCC region. And in order to provide that service, centralized air conditioning, they are using mainly cool water to cool the air under the air conditioning system. So to produce the cool water that they're using for the centralized air conditioning, they have cooling plants. It's not power plant, it's cooling plants. A plant to produce cool water that is distributed via underground pipes to the various buildings in the GCC region. So this project is to construct 3 additional cooling plants for Tabreed. Okay, so Tabreed literally means cooling. Okay, from the word barada, barid, Tabreed. So cooling. So it's a company to do air conditioning. So for this project, they needed 200 million US dollar to do the construction of the 3 cooling plants, A, B, and C. So they have the issuer, NSPV, Tabreed 2006 Financing Corporation, the obligor, the original party, or the partner in this, they have like, it's a kind of musyarakah, but they do istisna and then ijara. So the original obligor was actually Tabreed, the National Central Cooling Company. The amount was 200 million for this 2006 Tabreed Sukuk. It was rated by Standard & Poor's as BBB minus. Issuance date was 2006 and maturity was 2011. The coupon reflects the rental rate. Basically, it's 6 monthly USD LIBOR plus 135 basis points. Most investors came from Middle East, plus some from Asia and Europe. The structure, actually, you can see they have like during the construction, the istisna stage. This is the initial part, istisna ijara. So during the istisna stage, they set up a special purpose company, the SPV, who's going to be the issuer. So the SPV issued the sukuk to the investors, to the sukuk holders, and the sukuk holders paid 200 million US dollar. And this is actually used to pay for the istisna purchase price. So SPV is purchasing the cooling plant to be constructed by Tabreed. Okay, so by virtue of this istisna contract, SPV paid 200 million to Tabreed. So by the end of that transaction, Tabreed gets 200 million that they're going to use to do the construction of the cooling plant. Okay. At the same time, Tabreed also provide completion cash guarantee. Basically, this is to provide comfort to the investors that the construction is going to be properly performed, right? So they have this performance guarantee, cash performance guarantee provided by Tabrid to the SPV. Basically, this completion cash guarantee is provided on the periodic basis, and it matches with the periodic distribution payable to the sukuk holders, calculated based on an agreed formula. And they have the provision that during the istisna, if the construction is not completed within the time specified, then Tabrid will still continue to pay the completion cash guarantee on periodic basis until completion is achieved. Okay, so this basically completion cash guarantee given by the company to make sure that the construction is completed as per the agreement. Now, during Ijara stage, this is like after completion of the construction, then Tabrid lease the asset. But the lease agreement actually has been simultaneously signed during the istisna. Okay, so when you sign istisna, you also sign the Ijara. Okay, and this Ijara is actually signed now but effective upon completion and delivery of the cooling plant. Okay, so as and when any of the cooling plants or part thereof are completed and delivered, remember there are 3 cooling plants. Okay, so cooling plant A completed, delivered. Okay, so the Ijara will kickstart. And then the next one, second cooling plant B completed, delivered, and then the Ijara for that cooling plant B will kickstart. Okay, so the same when it's delivered, then the same will immediately become subject to the lease agreement. Okay. Got delayed and everything. This is not contract will start afterwards. The Ijara. Ijara will start later, but they will have to pay the cash guarantee, cash performance guarantee. Kan, under the earlier during Ijara, during istisna stage. Ijara stage means that you completed any of, let's say A completed, then the Ijara will start for A. But B still under istisna. Okay. So they have A, B, C, actually 3 cooling plants. And then the rental will be paid, calculated on the rental calculation formula. Remember the 6-month USD LIBOR plus 125 basis points. And okay, it will be paid by way of periodic distribution. And then there will be purchase undertaking. There's also purchase undertaking. There are 2 scenarios where the purchase undertaking will be triggered. Basically, Tabrid make a purchase undertaking that it will purchase if it's upon default, and if the default happens during istisna stage. So what will be Tabrid purchasing? Basically, Tabrid will purchase whatever portion of the cooling plant that had been constructed as is where is lah, and delivered to the SPV at the price corresponding to the value thereof. Okay, but if the default happens during the lease, meaning that there's completion already, then they will actually buy the completed cooling plant at a value equal to the aggregate of the outstanding principal value of the sukuk. And that's if there is default. That's the first scenario. If default happen during construction, or if the default happen after construction during Ijara. But the purchase undertaking will also be triggered upon maturity. Okay, so Tabrid undertakes to purchase the cooling plant at value equal to aggregate of the outstanding principal value of the sukuk upon maturity of the lease. So they have, if I remember correctly, it was 5 years maturity. So after 5 years, if no default, then Tabrid will buy the completed cooling plants from the sukuk holders through the SPV as per the formula mentioned just now. Okay, are you clear? So there is first istisna, and then they have also Ijara. So they call it istisna Ijara sukuk. These are all signed at the time of issuance. So they signed the istisna, they signed the Ijara, but under the Ijara it mentioned that Yeah, we sign it now, but the ijarah starts upon delivery of any of the cooling plant or part thereof. Okay, and then they are also sign the purchase undertaking. Then, but the purchase undertaking will be triggered in this either default or maturity.
Like, why is a condition of the second contract depending on the first contract completion? It can be independent.
Actually, from the Sharia perspective, they are treated as independent lah. So you do the istisna, and then you do the ijarah, and then you do the purchase undertaking. So these are like independent lah.
Someone that is like contested, you can say like a condition of the first one, only the second one can execute.
Yeah, because if you look at the condition of the ijarah, you need to have the asset delivered. So if the construction did not complete, but you can see that like default, say you don't get it constructed, you just buy whatever is completed, right? So you have to look back at the terms and conditions, like even for ijarah, as and when any of the asset is completed and delivered, then the ijarah will kickstart for that portion of the asset. Yeah. Yeah. Okay. Okay, so we are done with the project financing using the debt base lah. Basically, you have sale. Yes. Yeah. Mm-hmm. Mm.
It's not stage before my experience.
Default actually by the obligor. It's tabrid. No, sukuk holders are the investors. You can see here, obligor, National Central Cooling Company, tabrid, which is the public joint stock company in UAE. That's the company, basically the air cooling, the air conditioning company. The issue is just an SPV, Tabrid 06 Financing Corporation. Normally, SPV is acting on behalf of the investors, which are the sukuk holders. They did not default. This is the contract in case of, okay. So just to explain to you, they did not default, but they have this provision, purchase undertaking by Tabrid, by the obligor, that they are going to they are going to purchase the asset under the sukuk, which is the cooling plant, in two scenarios. One is if there is default, they're going to purchase. Second, upon maturity of the sukuk, they are going to purchase because they wanted to have the cooling plant, right? So under normal situation, no default, after 5 years, I'm going to buy the cooling plant. So they have agreed on the purchase undertaking and the price, the formula on how to calculate the price of the cooling plant upon maturity of the 5 years. Okay, but they also provide, let's say, what if default? What if Tabrid default in paying or in doing their obligation? Their obligation, one is to do the construction because they're also the person constructing. Secondly, if completed, they have to pay the rental, right? So if they are default, if during construction, they're just going to buy whatever asset that has been constructed, and they're going to pay the price corresponding to the value thereof. This is actually to cater for any legal risk of default. If there is default, you have a right to recourse to Tabrid. Because under the original istisna, you are purchasing the asset. So let's say something happens, then you want to have recourse to Tabrid. So that's why you have created this purchase undertaking. So it provides a mechanism for investors to enforce their right through the SPV by asking Tabrid, okay, and now you cannot continue, say they completed cooling plant A, but they cannot complete cooling plant B and C. So then Tabrid will actually undertake to buy cooling plant A and pay the value of that cooling plant A, so the investors get back their money. And then for cooling plan B and C, which is not being constructed yet, they will actually just take their money back. Because normally the money that is not being used for that project yet, they put under a special account. This account normally they are FSRA, right? The Financial Services Reserve Account. They'll be trustee looking after those assets. So they can actually recover back those money. But the one that has been put into the construction, so basically the obligor undertakes to just buy whatever that is there and add the value commensurating with that asset. So let's say even all the asset has been completed, but you default, basically you default in paying the rental, then you undertake to buy all the cooling plant at the price which is at the formula just now, outstanding principal value of the sukuk, to allow sukuk investors to get back their principal, remaining outstanding principal. So these are actually legal safeguards provided in the undertaking. So that's the purpose of the purchase undertaking, to protect the interests of the investors. And it will be normally enforced by the SPV, by the issuer. So what is interesting is normally in terms of legal, are you from legal background? Oh, banker. Okay, so for those from the legal, because this is like cross-border, you have this asset in UAE, but you have investors from Europe, from other places, from Middle East. Normally, the one relating to purchase undertaking, they would make it under English law so that they can enforce. But the one related to maybe the initial sale of the land, because it's like very much based on the land of where the land is located, so they can maybe following UAE law or the purchase of the land, but enforcement of purchase undertaking normally using a law agreed by the parties. Cross-border jurisdiction, normally they use either New York or English law. Just like the Dana Gas, they use English law for the purchase undertaking. Okay, are you clear on that? Okay. Okay, so we are done with lease. Lease I also consider as debt because you have the obligation to pay the rental. Okay. For equity-based project financing, this is also possible. So equity-based means that you are using contract which are not creating direct debt obligation, like mudarabah and musyarakah lah. Okay, so they're going to share the profits. That if there's any loss, technically the partners in the mudarabah and musyarakah will also be liable to bear the losses. Okay. So this is a simple illustration of mudarabah project financing. I think by now you are familiar what mudarabah is. How is it different from musyarakah? So mudarabah is basically where one party provide capital, the other party provide the work. So in the case of financing, the party providing the capital would be the financier. The party doing the work would be the project company. This is normal, okay? So you have financier giving money to the project company. Project company will do the project, and if there's profit and revenue, the profit will be shared between the capital provider, the financier, and the project company. If there is loss, then the loss will be borne by the capital provider. The monetary loss borne by the capital provider, because project company do not put money, they don't bear monetary loss, but they lost their effort. They have work in the project, they don't get any payment for that. Okay, so that in simple terms what mudarabah is. So there's no real debt obligation, it's more like equity, like you are going to share profits. Okay, and you're taking the risk of the project. Okay. Another feature of mudarabah is that when the financier provide 100% capital, but the financier generally do not interfere in the management of the project, because the project will be directly under the work and also the job of the mudarib of the project company. But they can take up follow-up and supervision tasks lah. Like you can ask them to report and update what happens to the project. Okay. And profit is to be negotiated between them. Okay. Loss, like I said, financial loss borne by the financier, unless if they can show that the loss is caused by the fraud of the project company or negligence or breach of terms in the mudharabah by the project company, then you can ask the project company to indemnify the financier for the loss that had happened. So this is musyarakah. Another simple illustration of musyarakah. The main difference of musyarakah project financing is that the capital is now shared between financier and project company. It's not 100% from financier. Financier puts some portion of capital, project company puts some portion, but still the active partner would be the project company who's doing the project. And again, if there's revenue and profit, it will be shared between the financier and project company. If there is loss, loss will be shared also between the project company and the financier, proportionate to their capital contribution. So loss always pro rata, but capital can be pro rata. Profit can be pro rata, can also be based on negotiation. Another agreed ratio based on negotiation. Okay. So the main feature of equity-based project financing, there is capital contribution. It can be from one party like mudharabah, it can be by both parties like musyarakah. Profit is neither certain nor fixed. So we don't know yet how much profit actually you can get. It's not fixed. It depends very much on the actual profit made in the project. Sharing in both profit and losses. Management or running of the project most of the time done by the project company lah, because financier will be the silent or domain partner. Credit risk is there, performance and business risk is also there. Generally, there's no collateral, but in some structure, we can have limited recourse collateral, where the collateral is to cover for negligence, fraud, breach of terms of the active partner of the project company. So is there moral hazard? I think moral hazard is everywhere basically. Even for debt-based or equity-based, you always have moral hazard in your counterparty if your counterparty is not disciplined and not performing their obligations. Yes.
It cannot be a related party be a guarantee as well. For example,
Yeah.
like that company has a sister company, but
Yeah.
cannot provide her.
Okay. So technically, because there's no guarantee on profit, so you cannot have a guarantee from the company itself. Whether on the capital or profit, you cannot get the company to guarantee. And by way of extension, also like you said, you cannot get a guarantee from a related party, like your sister company, your holding company, cannot provide a guarantee in favor of the project company to guarantee the capital or profit under the project. Okay? Yeah. Third party guarantee is possible. It depends. We have situations where you have guarantee by third party. In Malaysia, we have Dana Jamin to provide third-party guarantee to any issuer of bond or sukuk who require a kind of further credit enhancement. So you can have third-party guarantee. But not necessarily lah. It's not like always to have third-party guarantee. Sometimes issuer or obligor has enough credit standing, so they don't need a third-party guarantee, or the project itself is strong, so you don't need a third-party guarantee. But sometimes you may have the kind of indirect or direct guarantee by third party, or like the case some of concession by government entity or something like that. Third party guarantee, no issue. What is an issue if it's from the party themselves?
just want the government to maintain that particular golden shares in that particular company.
I think that's not like guarantee, right? It's not really
It's
guarantee.
not like
Yeah, basically we want to maintain the strength. I think that can be done. It's under the positive and negative governance, right? Governance. I think that's possible. This is I think in Masyarakat Mudharabah, there's a lot of positive and negative governance what the company can do and cannot do to make sure that the standing of the company is maintained. Let's say even their gearing, you can make covenants on their gearing, their undertaking other obligations with other party, because that would affect their cash flow and things like that. You can have positive and negative covenants. These are normal strategic terms and conditions. So if they breach that term and condition, it cause loss, then you can get indemnity from that project company. And you can create collateral to cover for that kind of breaches. Okay. So basically, some people may have the perception that equity financing is risky. Bank provide 100% financing in the case of Mudharabah, but the bank has the ability to really scrutinize feasibility of the project, whether they have the necessary manpower, skill set to evaluate projects and things like that. Okay, so these are some of the issues. It's not really debt-based, so no obligation to pay back the amount of financing if there is genuine loss not caused by any fault of the project manager. I mean, just due to commercial things that is beyond the control of the project company, right? So no obligation to pay those amounts. How do you determine the risk? How you manage the risk? And then sometimes amendment of the terms, like you have agreed on a profit sharing ratio, then you want to change it. Basically, everything requires mutual consent. So you cannot halfway unilaterally change the profit sharing ratio. That's not possible. Okay. Another issue is financing. Normally, you want to have profit distribution, but sometimes when the asset is still not ready, not yet generating income, there's no possibility of having profit to be distributed. Guarantee must be third party. No problem with third party guarantee. The only problem is whether that third party can charge a fee for providing that third party guarantee. Syariah opinion in Malaysia, we allow. Other places, generally, they don't allow for charging fee for giving a guarantee by the third party. Undertaking to waive the right to the profit upfront. So sometimes project company, they say we expect to give you a profit of this amount, but it's just expected or interim kind of indication. But to further enhance that, sometimes the project company will say that, well, unless you get your profit, I will not take my profit. Okay, so you are waiving your right to the profit in preference for the sukuk holders or for the investors. So whether this is allowed or not. So the one which is agreed upon by all, you can waive your right to profit, but you can only waive it at the time profit is realized. At the time of distribution, you say, okay, I will not be taking, you just take this profit so that you get your expected rate that I have indicated earlier. But to do it upfront, now when you take the money, you say expected this amount and I agree to waive my. So that one, some scholars allow, like in Malaysia, they say you can do upfront tanazul, upfront waiving of your profit. But majority said no. You can promise now to waive, but at the end of the day, once the profit is realized, you still have the right whether to ratify, to waive, or say I don't want to waive, I want to take my profit. So subject to ratification at the time of distribution of that profit. Okay, yes.
They change the set of the customer, they change the DSR.
Tak boleh.
Does that, from Sharia point of view, does the Sharia point of event?
it is non-syariah compliant and actually it's not effective lah. So the original rate will still apply. Because that's the one agreed. Istishabul asli. You go back, what is the one agreed? That this previous one. The new one, not agreed by the other party, right? Not even informed to them. So it's not effective. And it's actually, if you still charge the new rate, it's non-syariah compliant. So you have to return back lah whatever extra that you have charged. You have to go back to the original sharing. Okay. Oops. Responsibility of bearing the losses. I have to explain this one. Generally, if the manager or the project company has done everything according to the terms and conditions, etc., and the loss is due to business cycle or whatever, then they will not be responsible. But if it's due to their faults, breach of covenants, negligence, then they will have to indemnify the losses. Potentially, of course, investors have higher risk in the event of loss, and investors also and financiers, they are not equipped with the skill and expertise to manage the project lah. You don't know about cooling plants, you don't know about oil and gas, you don't know about a lot of things, so you don't know how to monitor and whatnot. Okay, so that's why normally you do a lot of positive and negative covenants to gather about those things, and they will have consultants, experts to advise them how to go about protecting the rights of the investors and financiers. Okay. So give you some examples of real transactions where they use mudarabah. Like for example, we have this, again, we are flying to UAE. During the boom years, they have a lot of construction. So one of the projects by Aldar, which is actually the construction, real property, real estate company in UAE. So they have issued again 2.53 billion, a huge sum for development, real estate development in UAE. And if you look at the issuer and trustee, this is just SPV, Aldar Funding, incorporated in Jersey. And the actual obligor is the UAE company, Aldar Properties Public Joint Stock Company. Okay. Regulation as 5 years. The profit rate actually expected to be equivalent to 5.767% per annum payable quarterly. So this is expected. They cannot guarantee this. But you can see they have done some kind of smoothening of that profit distribution by saying that if there is excess profit, meaning they made a lot of profit, is more than the 5.767% that is expected, they will give the excess to the mudarib, to the project company as incentive. On the reverse, if there is a shortfall, then the mudarib undertake to top up like an advance. They will advance first their money, because like in construction, sometimes cash flow, for that quarter, you have met the sale, but money has not come in, so you advance your money first, and then with the expectation that in the next quarter, the money will come in and you will deduct from there. So, they have this top-up undertaking, and then they have also purchase undertaking. Basically, at the end of the 5 years, obligor, see here, in its corporate capacity, undertakes to purchase the mudarabah asset at par value. So they carefully word it as in their corporate capacity, not in their capacity as mudarib, because there will be an issue that you are guaranteeing the return of capital, but in the corporate capacity, as Aldar, I'm interested to buy those assets. I want to buy those assets in my corporate capacity, like changing hats. And then they have a security given for the purchase undertaking, because you can see purchase undertaking worth 2.53 billion. Okay, so they have to put some kind of security in the form of land to secure the payment of that purchase undertaking amount. Qard, loan, interest-free loan.
For the
No.
contribution is that some kind of
Yeah, this is the issue actually. So they want to top up and they give court, and this is mudarabah, right? So when they did this transaction, it was approved by the Sharia advisor. On the basis there is a promise to make the court in the future. And let's say if at the end there's no profit, so that money has to be paid back because it's court, right? So you are not really guaranteeing. This is the argument lah, okay? But actually when they do it, they say we know the money is going to come in, but because of the payment mismatch and things like that, so we are paying first using our money, but when the profit comes in, we're going to set off with that profit. So that's the whole idea lah, to smoothen the payment, and that's the argument. And then the Sharia advisor said, okay, because it's court, so that means if finally no profit, then there's obligation on the investor to refund back lah, the money that has been advanced by the moderate, right? So, and then when they say 5.767%, expected, expected, so that means it's not like guarantee. So that's the argument. So that's why it was approved by the Sharia advisor. But later, I think I put it here, there was actually later a challenge by the by the AOF, Sharia Board. I think there was this transaction, there was also another transaction, a few transactions like Dubai Port, Aldar, and there was another one, Abar. They have all these purchase undertaking, top up in the case of shortfall. So this matter was brought to, although it was approved by the individual Sharia advisor or the committee for the transaction, but it was brought to the attention of the AOF Sharia Board. And saying that, well, they use all this undertaking to actually make what was previously not allowed in Mudarabah or Musyarakah to become at the end something like almost like guarantee or fixing the profit, right? So the AOF Sharia Board actually had a lot of discussion. I think they have 3 or 4 sittings. They have their members, they commission people to do papers, discussion. After that long discussion, finally by way of majority decision. So meaning some still said this is okay, but majority, not a very big majority, just a thin majority say no, you cannot have this undertaking top up, even purchase undertaking to buy at par value, even in your corporate capacity. It's like indirectly guaranteeing the return of capital. So they don't allow this practice. I think in February 2008, it was not allowed by the AOF pronouncement, Sharia Board or AOF.
Oh, just a question. If I'm not mistaken, BNM policy document, HIBA allows, I mean, not court, but HIBA, they allow HIBA to be conducted together with Mudarabah and Musyarakah. Is that
That's a different scenario. That is for the, I think that is for the, I'm not sure, maybe if I understand you correctly, it's more like for the Mudarabah account or what? Investment account.
on Mudarabah PB, it's undertaking portion, which I think in my personal opinion, it takes away the true nature of Mudarabah, because you go and ring fence it a little too much.
Yeah,
The element of,
risk, yeah,
investment based.
yeah.
I think we table somewhat like this to our Sharia committee as well. Try to ring fence as many risks as possible. Then they said that this is no longer Mudarabah.
Yeah.
This is a dilution of the
Yeah,
Mudarabah.
dilution of the feature, the equity feature of Mudarabah and Musyarakah. So you have to look back at the paragraph. I'm not sure which one that you are referring to, but basically for Malaysian Sharia pronouncement, they have actually allowed the minority view in the AOF. Basically, they allow based on the wa'ad lah, which is undertaking to purchase. I mean, for AOF, they allow for purchase undertaking, but they don't allow for purchase undertaking at a fixed price at the time of issuance. So you can have purchase undertaking, but the price is to be determined at the time of purchase. based on market value or any other value agreed by the parties. So the difference with the Malaysian official shareholding is that we allow purchase undertaking and we can even fix the price at the time of issuance, not necessarily at the time of purchase upon when the purchase happens. Okay. The argument was because we do undertaking now, but we cannot guarantee that there will be asset. If the mudarabah phase, there's no asset, there's nothing to be purchased. Okay. No, they allow for, you can have 5.767 as expected. So that means if there's no profit, you cannot top up. Okay. And you can have purchase undertaking, but you cannot say purchase undertaking at par value at the time of issuance. At the time of purchase, yeah, you can agree on a price. There, it can be like par value also, but you cannot promise upfront. Yeah. That is different. PR because you from your own reserve, profit reserve. But this one is from the Mudarib's own money. Yeah. But even AOFI, they allow for liquidity facility during shortfall, but the liquidity facility must not come from the Mudarib. It can be from third party. Like you can get financing from other bank to pay for that shortfall momentarily. Third party lah, third party, not direct from the Mudarib own funds. Okay. So this is the transaction structure lah. So ada funding, the SPV issued the sukuk, is used by the Mudarib in their real estate business. And then they have, this is quite straightforward actually, but they have all this enhancement to make the equity sukuk behave like a fixed income instrument. So they have the purchase undertaking, they have the top up and whatnots lah. Okay. This is another transaction in Malaysia. We have also musyarakah sukuk by Asar Chemical in Sarawak company. The project was actually to construct independent oil terminal in Sarawak. It was not that much, and the cost was 150 million. So the company here, Asar Chemical, they have obtained a contract with some oil companies. They call it user agreement. So the oil companies are going to use the independent oil terminal, and they're going to pay the company a certain amount, a contractual amount for utilization of the independent oil terminal, IOT. But independent oil terminal is yet to be constructed by the company. They have started construction, but they need to complete it so that they can perform their obligation with the oil companies. So they actually issue the sukuk musyarakah to get financing for the completion of the construction. So the land and also the small portion that they have started to construct is valued. So that was about 13% of the total capital. And the sukuk holders inject the remaining cash capital, 150 million. Okay. So the project of the musyarakah is to construct the independent oil terminal. Upon completion, they are going to lease the oil terminal back to the company. And the company will then use it under the contract, and the oil companies will pay. Okay. So because construction was expected to be like between 18 months to 1 year, so to 2 years. So basically, it cannot be used for the first 2 years under construction. So that's why they have agreed that profit sharing will only start on the second year after completion of the IOT, and then IOT can be leased, and the oil companies can use, and they start paying. So cash flow start to come. Then only there will be payment of profit. So they actually did complete the construction within that expected 12 to 18 months. So then they lease it to the company company pay rental. Actually, the rental is fed by, of course, the money paid by the oil companies who are using the independent oil terminal. Okay, clear? So this one no purchase undertaking or whatever lah. So this like pure musyarakah kind of structure. And this was done before Aldar. Purchase undertaking was not known yet at this time. This was 2005, I think. Aldar was 2006. And wings, this is again going back to Dubai. So they have wings, actually the name of the SPV, who's issuing the sukuk. Obligor was Emirates Airlines. So this was one of the sukuk issuance by Emirates Airlines. They have after this another issuance, a number of issuances. This was the one for funding project that was to construct new headquarters for Emirates Airlines and also new engineering center for Emirates Airlines. Okay, so they raised, I think, 550 million US dollar, more than half billion. So it's a musyarakah. So Emirates Airlines contribute in kind, basically the land parcels upon which they're going to build those buildings, valued at 100 million US dollars. And the remaining cash capital provided by the sukuk holders when they subscribe to the sukuk, pay money to Wings. So Wings is their agent to enter into musyarakah. So Wings put money as a partner in the musyarakah, 550 million. So they have this musyarakah. Purpose is to construct new headquarters and new engineering center. And this will be leased to Emirates Airlines. So Emirates Airlines is a partner in the musyarakah. They are also lessee for the two buildings. Okay. And they have also undertaking. So the rental paid will be contributing to the periodic distribution of profits to the sukuk holders. And there's also purchase undertaking, and this was also done prior to the AOF pronouncement in 2008. So purchase undertaking to buy the building. So they divide the building into units. So they're buying those units of the building from the musyarakah at an agreed exercise price. Okay, clear? Okay. So there are lots of project financing using sukuk issuances. For example, we have Sarawak Power Generation using musyarakah, 215 million ringgit. Mukah Power Generation using Mudharabah, 950 million ringgit. Penang Bridge using Istisna, 685 million ringgit. Jimah Energy, 4.8 billion ringgit. IJN Capital Musyarakah for Hospital, 209 million. Penang Port, Kapal Energy Ventures, Sarawak Power Generation, this one is Sarawak Specialist Hospital. So there are lots of projects using Islamic project financing in Malaysia as well as globally. You have Aldar, Nakhil, Abar, Gold Sukuk, the MCC, Emirates Airlines, Dubai Department of Civil Aviation for their airport expansion. So these are all using sukuk issuances to project finance those projects lah. Basically infrastructure, airport expansion and whatnot. So in conclusion, basically you can see that there are various structures that you can choose. You can make the structure better, competitive, more efficient. Basically, they're looking, a lot of that is about commercial, about risk management, about cost. But we are also looking at Sharia concerns, Sharia concerns, whether you can do purchase undertaking, or how do you smoothen the payment of the profit and whatnot. Okay. If you go for Sharia compliant that is agreed by all scholars, then in terms of global acceptance and recognition will be easier. So any question from you or any comments or any addition or anything that you want to add? I think this is my last slide. Yes. Yeah. Aha.
Apply dalam all this project
Mhm.
financing ni.
Aha.
Maksudnya setiap transaction dokumen tu dia mesti stand alone untuk menunjukkan setiap kontrak tu ataupun
Yeah. Actually, the standalone requirement is more for the purpose of Sharia compliance. Because if you combine contracts, sometimes the features of one contract does not tally with the other. So it may cause some kind of dilution of rights and obligation in the other contract. And it may also cause some kind of uncertainty on the rights of the parties. And there's also another reason for that. There was a narration, a hadith of the Prophet ﷺ, that the Prophet prohibited two sale in one. Or even not to say like the combination of a sale contract and a loan contract. So in general, there are some prohibition of combining contracts because it can be in a way affecting the full effect of the other contract, and also some way can be considered as a kind of abuse of some features of the other contract, like the prohibition of sale contract with a loan loan contract, because you cannot charge extra benefit on the loan. Yeah, so you have a clear court Hassan. But because you have also a sale contract which is not standalone from the loan, which is sort of conditional to the loan, so you can take your profit from the sale, which is actually a camouflage of the benefit they're expecting to get from your loan. You are not taking benefit from your loan, but you're taking benefit extra on the sale leg of the transaction. So this is just an example.
maksudnya
Yeah.
dia boleh ada so-called master agreement untuk
In terms of documentation, like your documents, I mean, of course, you bundle all the documents in one transaction document, but the contract's effect should be independent and stand alone. So let's say the test is like, say, you have just now the example of istisna 1 and istisna 2. So if for one reason or the other, like istisna 1 actually becomes not valid, or the parties decide to terminate istisna 1, does it also terminate istisna 2? So if they are standalone, that means it doesn't. So istisna 2 can still be effective. I mean, you can, it's still enforceable. So it's not interdependent on each other. So that's the main thing that needs to be established, because under, even in terms of the legal, you talk about privity of contract, right? The first contract is between the bank and the customer. The second contract is between the bank and the contractor. So these are two separate parties. They are not privy to each other. So this party cannot enforce this contract. This party also cannot enforce the other contract, right?
same purpose.
The specification of the asset are the same, but the parties are different. So they should effectively be separate in order for each set of the contracting parties to have the enjoyment of their rights and also to be liable of their obligations under their separate contract. So it's basically clarity, like clarity of contract, clarity of the contract, and the parties cannot abuse the rights of each other, and it's about privity of contract as well. Yeah. 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 I think for me, that's more in terms of your record lah. It's like more record, but it's not like concluding the transaction. To give you an example of combining is perhaps when we have previously, I think, are you familiar with Ba'al-Inah practice before? Yeah, Ba'al-Inah practice. So remember why it was discontinued, and if you remember the various Sharia Council of Negara resolution, so they said, I think the previous resolution, they said this asset purchase agreement, asset sale agreement must be standalone. There shouldn't be interconditionality between the two. Yeah. Yeah, when you do intercondition, I enter this contract to buy from you with the condition that you sell to me under the next leg. So that's interconditionality, which sort of link between the first contract and the second. That is not allowed. Yeah, yeah.
I think on the quality mobile transaction, for example, we have the master agreement, and in the master agreement we do have the wakala contract, and also the beberapa contract. So I think that means the combine of the agreement.
I mean, the contracts, the wakalah is separate. The murabahah is separate. You have the wakalah, and even if you don't have the murabahah, this wakalah still stand, right? Yeah. So, but you can file the documents together in one file, in terms of the recording, court purposes, the recording of the agreements. But in terms of legal effect. And also, the understanding of those contracts, they are separate and standalone. Another example of the combining that is not allowed is, for example, when you do the hire purchase, conventional hire purchase, the hiring and the purchase is together, right? It's in the same document, it's all described in the same document that hirer and purchaser is, at the same time it's hiring, at the same time it's a purchasing, right? Under Islamic principle, they must have separate contract, the hiring, the leasing, and then after leasing, and only you can do the sale, because both contract has different effect. For the hiring, the lessor can only lease the asset to the lessee when the lessor is the owner of the asset. So the moment the lessor sold the asset to the lessee, no more ownership on the lessor, and the lessor can no longer lease. So the lease will automatically terminate upon the sale. And the sale have a different effect. So now the owner of the asset belongs to the buyer. So if you combine sale and lease together in one, then it becomes very unclear as to rights of the party. Who is the owner of the asset? What are the rights of the parties? So that's why for hire purchase, Islamic hire purchase, we have to have separate between the leasing and the purchase. Yeah. Okay. Revolving can be like let's say community murabaha, but you can also have like in the example we have revolving using the for the apa nama tu as Tanjung Bin, actually they do it as multiple drawdown and also revolving, if I'm not mistaken. For the they do the drawdown for the first tranche, and then they can do the next drawdown, and if they pay the original, yeah. Mm. Yeah, I'm not sure, but I think to some extent, if you look at mudarabah and musyarakah, I believe it can also be structured as revolving, in the sense that you can commit yourself to provide capital up to a certain limit to the partner, and as and when the partner needs, they can request for the capital. And then you have a tenure for the repayment of the capital upon completion of certain project. So you get a return of capital. So your limit for capital contribution may be adjusted accordingly. Maybe, I'm not sure, I have not seen any structure, but I think maybe it can be along that line. Yeah. Yeah, maybe mudarabah musyarakah, but I'm not sure. Just thinking aloud. Yeah. Okay. Any other questions? Yes. Yeah. Parent tak boleh. Third party must be independent third party. Related party cannot. Related party not considered as third party. Although from legal entity perspective, they are separate, but from Islamic perspective, because you are related party lah, so generally cannot lah, especially if you have control, but parent, yeah. Yes.
thoughts on debt versus equity financing. Some people say that equity financing is more Islamic than debt financing.
Oh, okay.
And then does debt financing does not really contribute to the real economy?
Mm. Okay. I think this one is, to me, debt financing versus equity financing. What I can say is both are permissible according to Islam. Debt is permissible, equity also permissible. Each have their own role. And to say that one is preferred over the other for me is not accurate. Because if you look at the practice, the sources of Islamic law, let's say in the Quran itself, there's a clear verse talking about halallahu al-bai'ah. Allah has permitted sale. Wa harrama riba. And Allah prohibited riba. But Allah permitted sale. And there are verses talking about the sale contract that involve future obligation. Meaning there is a sale contract which is mudayana, ayatul mudayana. So it can be in the form of either the debt in the form of price, like our baik bithaman ajil, or debt in the form of goods like ba'as salam. So if you look at the ayatul mudayana, ya ayyuhallazina amanu iza tadayantum bidaynin ila ajalin musamma, the longest verse in the Quran, Mufassir said that is actually about salam and also deferred payments contract, credit sale, and you sell and you pay later. So the verse recognize it and say you document it to make sure so you know the obligation of the parties, how much they are owing, they have to pay the debt. So it is recognized and considered as valid and it meet the purpose of the need of the people. Not all the time people have cash. So if they can pay by way of credit, it facilitate them in acquiring assets. The Prophet himself, when he died, Sallallahu Alaihi Wasallam, he actually had a debt owing because he bought some food from a Jew and he actually gave his armor as a collateral. So when he died, I think, I can't remember, one of companions actually paid for the debt from the Prophet's assets, basically. So that means it's something which is permissible, it meets the needs of the people. If you prohibit that, it's causing hardship to the people. Because not all the time everyone has cash, so they need to buy something on credit. What is important, they have to pay the debt. Because this is something that is also highlighted in Islam. When you have debt, you have to pay. If you don't pay the debt, it's one of the serious sin. That's why the Prophet ﷺ refused to pray over the deceased companion because he knows that this person has a debt and not sure who's going to pay the debt. So whenever he's asked to pray over a deceased companion, he will ask whether this companion has a debt. If there is a debt, the Prophet will ask another person to pray. He doesn't want to pray because there's a debt obligation that has not been paid. But in that case, there was another company come and say, I guarantee to pay the debt, then only the Prophet will pray over the person. So payment of debt is a serious matter. You can have debt, but you have to pay. And there's many hadiths talking about if a person has a debt with the intention not to pay, then Allah will make it difficult for him. Okay, but if he has a debt with the intention to pay, Allah will make it easy for him to pay. Okay, that is about debt. Okay, about equity also, it is something permissible. It allows for expansion of what do you call it, business lah. If you have one person with their own capital is limited, if you combine the capital of many people, you have bigger capital base, you have more chance of expanding the business. So that's why in the hadith, the Prophet ﷺ said that Allah's blessings is in a partnership, basically in an equity venture, as long as they do not betray each other. Okay, if they betray each other, the blessing is gone. So in a partnership, there's also a verse in the Quran that وَكَثِيرٌ مِنَ الْخُلَطَاءِ لَا يَبْغِي بَعْضُهُمْ عَلَى بَعْضٍ. In a partnership, there's always a temptation for the partner to betray the other party, taking more than their due, either in the profit share or whatever. So we are cautioned against that. So although partnership is good, but we should also do partnership in a way which is morally and ethically correct and do not betray and abuse the right, because in a partnership, there's always this fiduciary relationship, there's always abuse of fiduciary relationship, and you're causing problem. So each has its own purpose. So I think for asset financing, to buy asset, you can use a debt-based instrument well. It's a very suitable mechanism. For business financing, for ventures, equity, I think is the best instrument. The problem is when you want to match between a round peg and a square hole, or square hole with a round peg. So it's like business financing, you want to use debt, it's difficult, like the sukuk is a fixed income instrument, and you want to have equity contract to fit into fixed income box. That's difficult. But if you use equity in stock market, in venture capital, private equity, that's a very good instrument. Yeah. So debt has its role, equity has its role, but you have to look at the maqasid of each of this contract and align it with the product or the instrument that you want to develop. Yeah. No, tabarruk is a different thing, because we have the normal debt base, we have the normal equity based contracts. We have also certain categories of product which comes under the purview of hiyal, purview of or makharij. They are actually solution or devices used to facilitate certain situations which we don't have other alternatives. Okay, so so under that will be inah, tawarruk, al-wafa, jual janji and whatnot. Okay, so these things, why Bank Negara asked the industry to try to find alternatives to tawarruk. One is because there's over concentration on use of tawarruk. And then talking about commodity, there's risk on availability of the commodity. So from regulator perspective, it's about risk management. And then there's also Sharia risk, because not all Sharia opinion allows for tawarruk, and even for those allowed, they have detailed, stringent rules on how to apply tawarruk in order to make it acceptable. Yeah. Okay. Another thing before we go, actually, I think my response with regards to the question on whether the commodity can be sold at a price higher, I think I gave a wrong inaccurate answer just now, because I said they bought at a discount. Sorry, they actually bought the commodity at a premium. Yeah, they bought the commodity at a premium from the broker. So the possibility of them being able to sell at a higher price is very minimal, because they already bought the commodity at a premium. Remember the question earlier? Your question, right? Yeah. So that's the answer. Not bought at discount. So there's a mistake. That's actually bought at a premium already. Yes. Okay. Actually, qard means loan. Qard Hasan means a good loan. Okay. From Islamic perspective, all loan must be free from riba. So from Islamic perspective, qard is an act of charity. So it is always Hasan lah. Basically, it's an act of charity. You help the borrower by giving him time to use the money. When the borrower repay exactly the principal sum. If you look at the verse of the Quran, falakum ru'usu amwalikum, you take your principal sum, la tazlimuna wa la tuzlamun. You are not causing injustice to the borrower, nor is the borrower causing injustice to you. Because they borrow 100, they pay 100. You are not being unjust to them, they are not being unjust to you, because you get back your 100 and you're not charging extra on them. So that's core under Islamic principle. But now, because we have conventional banks, they give loan, and from their perspective, time value of money. So whenever you give loan and there's time involved, you always charge extra. So to emphasize that it is Islamic loan, so people tend to add the word qard Hasan. Word Hasan, meaning that it's loan, but Hasan, it's a good loan. Basically, you don't charge anything. You pay back my money, but I'm not charging extra. So that's why they add the term Qard Hasan. But if the society already know that all qard must be free from interest, there's no need to put Hasan. All qard should be understood as not generating interest lah. Fee for what? Yeah, that is a bit tricky because whatever charge that you're going to charge over and above the principal sum must be actual direct cost. So you should be able to show proof lah. Let's say, yeah, I mean, you are doing that loan and then you have to pay the lawyer to prepare the document. So the actual cost lah. So if it's like percentage of the amount of money, then that give rise immediately trigger. Okay, why percentage to the amount of money? Shouldn't the work be the same even if the money is like $10 and $100? The preparation document should be at a flat rate. Okay? Yeah.
Short tenor loan, for example, let's say 2 weeks or 3 weeks. Okay, the cost incurred should be the same if you give the loan for 3 months or 6 months. So if I want to give a shorter term loan, which is the card, the fee incurred is actually the same.
Yeah, it's the same.
So, but then again, comparatively, the cost here and the short tenor basically doesn't jive, right? Because it's probably the cost of 500. I borrow for 1,000. The cost actually 500 because of the lawyer fee.
Yeah.
But the 1,000, if I borrow for 3 months, 6 months, actually goes for them because it's like time value of money. You compare 500 in 6 months, it's better for the customer. So that's a challenge. Another part is okay, the Negara does not allow fees charges.
I mean,
So the income, it's like say sort of the fees, but the administrative fees, like the person costs preparing the documentation, the level.
yeah, that is a bit difficult to quantify, like because the person is doing all other jobs as well. So how much can be attached to that document? Yeah, so that's the
Previously, yes, cannot, but with the technology, people
if you can show, you have to present, get your IBIM, go to Negara and convince Negara this is actual, then I think if you can justify, as long as you can justify lah. Sometimes what they consider as cost actually not attributed to that borrower, actually is to other people, right? So that's why we reject. Like even for the ta'wid amount, right? So if you can show and prove this your cost direct, I think there's no reason why Negara should reject. Yeah. Okay. Yeah. Any last question? I think we are nearing time. 2 minutes before 5:30. Any last question? No, Alhamdulillah. Okay, so everyone is happy, so we can go back. And all the best to you for. Do you have another session tomorrow, right? Yeah, one more day for you. So last session for me. Assalamualaikum warahmatullahi wabarakatuh.